Okay, good morning, good afternoon. I keep forgetting we got people from all parts of the world here. It's fantastic to hold this again. It's our 5th conference, and as you well know, it's 100% of the proceeds go to the Alzheimer's Association, which we're very proud of. And today we're very proud to say we've reached our target. We've reached our target of $15,000 in 4 weeks, which is incredible. I'm so proud, and just want to say thank you very much for that. Also want to say thank you very much for the speakers for donating their time. We've got the smartest brains in the world here today, and I want you to get as much out of them as you can and use it to your ability and able to make money. But I'm not going to speak for so long, which you'll probably be pleased to hear. But I'm going to hand over in a minute to Chris, and Chris is Executive Director of the Alzheimer's Association. He's going to give you a reason as to why we're doing this and the problem that we're facing out there with this disease. But first of all, I'm going to show you a short video, and then I'm going to hand over to Chris. But throughout the conference, you're going to see the speakers pop up, giving their presentations. You can have the ability to ask questions in the little box. Paul Johnson, who you see there, is going to be moderating as usual. He's moderated all our conferences. You're going to love him. And ultimately, at the end, we've got a raffle, give away a few prizes as well. So again, it's in the spirit of the charity, but we hope you can learn a lot and take a lot away today. So I'm going to share my screen here, and I'm going to play the video, and hopefully we can you can see this.
The first person to survive Alzheimer's disease is out there. They're going to hold on to everything the disease steals away. That smile they can't hide. That dance class they love. Every single piece of them is going to make it through. And the Alzheimer's Association is going to make it happen by funding research, advancing public policy, and spurring scientific breakthroughs. And by providing local support to those living with the disease and their caregivers, we're easing the burden for all those facing it until we accomplish our goal. Alzheimer's disease has devastated millions of lives, but that's all going to change when we reach the first survivor. But we won't get there without you. Join the fight with the Alzheimer's Association.
Good morning. I'm Christopher Smith, and I have the privileges of serving as the Executive Director of the Alzheimer's Association in New York, and I'm thrilled to be joining you today for the EDGE Conference. As you may know, the conference is in its 5th year and has been supporting the Alzheimer's Association since day one. We sincerely thank Jim Osman, everyone at the EDGE, and all of you for your support and your dedication to our mission. Jim is focused on taking advantage of special situations, unique opportunities, and undercovered spaces. Alzheimer's is certainly undercovered, and that makes sense. No one wants to focus on a disease that robs you of your memory and so much more. Most of us think of Alzheimer's as an old person's disease. something that might happen in the distant future. But that isn't always the case. While most people who get the disease are well over 65, there is a group of who develop younger onset Alzheimer's, which happens in people as young as their 40s and 50s. Though young onset is rare, Alzheimer's isn't. More than 6 million people in our country are living with the disease today, and it costs $355 billion a year to care for them. By 2050, it's estimated that 13 million people in the US will have Alzheimer's at a cost of over $1 trillion. Professionals in the finance industry are on the front lines in identifying people who may have Alzheimer's or another dementia, as problems managing money can be one of the first signs. The Alzheimer's Association is here to change the future. With your help, it will come as no surprise that the answer lies in investment. Good ideas need funding to get off the ground, and that's where we come in. The Alzheimer's Association is the largest nonprofit funder of Alzheimer's research. Right now, we have over $250 million invested in more than 750 projects in 39 countries. Our portfolio is structured to meet the needs of the field and take advantage of special situations. Because we're not allied with any company or government, we can be innovative in our choices. Our goal is to nurture fresh ideas that increase our understanding about the causes of Alzheimer's and how to treat it. Once those ideas are refined, they can attract more investment and start driving toward the finish line. This year, a drug crossed the finish line. Aducanumab became the first drug ever approved by the FDA to treat the underlying causes of Alzheimer's, and another drug from Eli Lilly is racing towards FDA review. By proving there is a path to regulatory approval for Alzheimer's drugs, Biogen has opened the gates for renewed interest and investment in this area. Lilly says it took its Alzheimer's R&D off the back burner after the approval of aducanumab. It's likely many other companies are doing the same. Momentum is building in this field. Aducanumab, known as Aduhelm, isn't a cure, but it is a stake in the ground. As we have seen with other diseases, the first approval leads to more, and that pace accelerates. There has never been more reason for hope that we will end Alzheimer's. And I thank Jim, The Edge, all of you for helping make that happen. Thank you.
Thank you, Chris. I'm glad he's a lot slicker than me at operating the machinery here. But listen, so let's get started. You know, the people I've assembled today are not only good in their respective fields, they're people I trust. And, you know, our tagline is investment ideas you can trust. And in this business, there's plenty of people, you know, who offer you advice, but can you trust them? And that's the key determinant of investing with people or you know, going along with their ideas. So I won't be running. I'm going to hand over to Paul in a second. Paul, we got just to give an overview of who we got today. Paul Johnson has been around for a long time. He's a Columbia professor. He's moderated all our conferences. Those who've been before will know him. Extremely knowledgeable. He's got a great book out there, and you should listen to him and really take in what he's got. We got David Marcus on the screen there. Has run Evermore Global, been around for as long as I can remember, and just full of experience and fantastic. Really a mainstay of our conferences, really, and you'll really get a lot out of him too. We've got George Muzea now. Might be interesting and new to some of you, but following people on the inside of companies is real key area which you should be looking at. And because, you know, ultimately, who knows what's going to happen to their company? They do. And, you know, if you can follow them and you can analyze them, and George has been doing this for 40 plus years, he's a real guy you should be taking in and using in your armory. We've got Jonathan Boyar who will be appearing. Jonathan as a legacy company since 1975 of looking at real value ideas. And, you know, I'm really excited to hear him. It's our first time at our conference, so I'm really excited to hear him myself. And we also got Joel Greenblatt. Joel will be joining us. Joel, you know, is just a legend, really, in the investing space. And anyone who looks at spin-offs would have read his book, who wants to be a stock market genius and all the little books that beat the market and all that sort of stuff. But he'll be joining us as well. So we really got some great people, and we got our own guy, Jonathan Morgan, at the end will highlight what's on the calendar and what to look for. So it's full of ideas today. Make sure you take notes. The video recording will be available to everyone who participated and who signed up tomorrow morning. So that'll be sent out. So without further ado, I'm going to hand over to Paul, and you know, he's going to get on with the interesting stuff and why you're here. And listen, I really appreciate it, and what you've donated, and you know, I'm really excited.
Did you mute so we don't get an echo? We have an echo. We should turn off. Try it now. Working, perfect, excellent. All right. Let me just clean up my screen for a second. All right. Certainly on a short-term basis, it's clear that the only thing that really matters in making money in stocks is anticipating investor expectations, just changes in investor expectations. But over time, and as your time horizon or your holding period extends, it's clear that the valuation is going to be determined by the economic value of the company and underlying the company. I think we've done, both in academic and in practice, done a very good job of understanding valuation kind of conceptually. We certainly understand the value of cash flows, and that debate's been kind of settled. The challenge we have, and the community has as general, is valuing growth. And without a question, the biggest challenge for all investors these days is valuing growth, because growth component of valuation is so large for so many companies. And it's something that if you kind of a discipline of value investing, the greats never really attacked well. Graham never really talked about it. Greenwald, who's done fantastic work in the area of competitive advantage and protecting cash flows, really has struggled with explaining growth. And even Mobison, who's done some terrific work on expectations related, he's struggled with growth. And so what I want to do is present a new framework to think about how to think about growth, the valuation of growth, and in particular, how to think about the impact growth has on that valuation. So I want to walk you through that for a few minutes. Sorry about that. Hold on a second. I have pulled up the wrong deck. My bad. There we go. That looks better. Apologize. All right, we're gonna start slightly theoretical for a moment, and then I'll get very practical very quickly. So just bear with me. If you think about the value of any asset, we know that it really comes down to a couple components, from cash flow, which drives the longer term value of all assets. And what we care about mostly there is the duration of the cash flow, the magnitude of the cash flow, and the growth in the cash flow. We've done a pretty good job of valuing duration, magnitude, it's growth that's the challenge. And this is all within, obviously, the acknowledgement of a great deal of uncertainty, and then the time value of money. Cash flows in the future are less valuable than today, all basic stuff. And we also know that the value of any asset can be modeled as a DCF. Now, I firmly believe that DCFs are impractical on a day-to-day basis because there's too many variables to control for. In the simplest sense, there's essentially three components you have to account for, and you only have a single equation, so you can't solve for them. But conceptually, it's a fantastic framework. And when you think about it, you know, free cash flow discounted back for time and uncertainty is the way we think of the value of an asset. But doing that in the real world at a practical level just is non-operational. So I want to talk about discounting for a moment, because it's incredibly important, particularly in this market. So if we look at the 30-year Treasury real rate, this is a pretty good proxy for the long-term discount rate for stocks. It's been below zero in the U.S. off and on now for a little bit over a year, down from 10 years ago 2%. If we look at a 5,000-year history, the real rate's 2 to 3% on average, with huge swings on both sides. Negative real rates is sort of a modern day phenomenon. However, if you look at that 30-year Treasury in a nominal basis, it's obviously much higher and more consistent with what we've seen over the last 10 or so years. And the difference is expectations for inflation. So you really have to think about inflation in your discounting, particularly in equities. Now, discount rates show up faster in the credit markets than they do in the equity market. There's always a lag, partially because cash flows grow in the equity market. Cash flows don't generally grow in the credit market. The bond market still doesn't believe in inflation. So that's an early sign, a canary in the coal mine. If the bond market were to start to worry about inflation and the rates were to tick up because of that, then I think you have to worry about that on the equity side. If you look at the annual US inflation rate, it's been kind of between 1% and 4% for 20 years. It broke out recently. I mean, the big question, is this real or not? Way beyond today's discussion. But if inflation were to tick back up and to be more permanent, that is going to find its way back into the discount rate. And that's going to be a challenge for equities. All right, risk premium roughly is 4.5% to 5%, fine. So the discount rate that we should be using for the overall stock market is nominally somewhere between 6% and 7%. That's the discount rate I've used for my S&P valuation, which I'm about to show you. I've used this discount rate on a time basis. All right, so if we say that the value of an asset is in fact the future cash flows discounted back, I'm going to use NOPAT as my proxy for free cash flows. Here's the exercise I want to walk you through. Slightly a thought experiment, and then we'll apply it to the real world. What if we assumed no growth? What if we assume that the NOPATs are equal to each other forever? And people say, well, you can't make that assumption because they're not going to be that way. And you stop and say, well, all valuation methods, everywhere from an EBITDA multiple to a PE to a DCF, all of them assume that there's a level of cash flow that's permanent, that lasts forever. They're all applied. We just don't pull it out. So all I've done is pull that out. Well, the nice part is if you assume no growth, then we can value that company trivial. It's trivial. The value of the stock is just that NOPAT capitalized by some discount rate. Now you can see why that discount rate really matters, because it's going to determine the value of the stock without growth. We're just trying to come up with a way of thinking about the company without growth. So we take NOPAT, come up with a number you think is steady state, going to last forever. Again, as a reminder, all valuation methods assume this, they just don't do it explicitly. If we take that, we then capitalize it by some discount rate. That gets us what is the value of the stock without growth, assuming no growth. Another way of thinking about that, that's your no growth steady state value, often referred to as earnings power value, EPV. All right, so that is what I want to call as our base camp. That's the value of the company without growth. Well, if we know the value of the company without growth, we actually can tease out what the value of the company is with growth. I'll walk you through that. So let's just take the enterprise value of a company. It's market value of the equity, market value of debt, minus excess cash, plus some other stuff for some companies. Most companies, it's simple. That is the market's estimate of the value of all cash flows. That's what the market believes those cash flows are worth. And what we as investors are trying to anticipate that value changing over time. And everybody has slightly different strategies. Some people are activists. Some people get very involved in influencing those future cash flows. Other people are maybe more short-term oriented, and what they're trying to do is anticipate changes in expectations of that enterprise value or changes in investor expectations. But we do know the enterprise value is the market's estimate, consensus estimate of the value of all future cash flows. Well, we know that the earnings power value is the value of the company with a steady state, no growth value of cash flows, as we define by NOPAT divided capitalized by I. Well, if we were to subtract the earnings power value from the enterprise value, guess what? We have the market implied value of growth. And I think that that insight is incredibly important because we now can think about growth as a separate component. Now, you certainly can spend time whether you think earnings power value is sustainable. If it's not sustainable, the value of growth will not over time materialize. But if you think that earnings power value is fairly steady, then the difference between the enterprise value and the earnings power value, EV minus EPV, is the market implied value of growth. All right, so here's the S&P quarterly earnings as reported. It's always got a lag. The last time they reported is March of 2021. The reason I bring this up is because I'm going to show you some valuation methods. And some people will push back and say, well, earnings are down, so it isn't the same. But in fact, earnings are at a record level in the second quarter. And I suspect the first quarter, second quarter, third quarter will follow suit. There's no reason to believe they won't. The economy's been very strong. All right, so we're dealing with peak earnings. All right, so here's your earnings power value for the S&P 500. And I calculated two averages, a 10-year average. So about 65% of the enterprise value is the earnings power value for the S&P on a 10-year average. On a 5-year average, it's closer to 56%. Now, if I take the enterprise value, subtract off the earnings power value for the S&P, I get the market implied value growth for the S&P 500. And you can see that this is the inverse of that last chart. So the 10-year average is 35%. The 5-year average is 44%. So I want to just give you, that's the market. What's interesting is that this is the highest. I have data going back 14 years. The 08-09 plateau is because earnings basically disappeared. The market didn't go to zero, so the implied value of growth was very high. But we're at a very high level for the S&P. We haven't seen this since really in 06 and 07. We haven't seen it this high. Interesting, in 11, which ended up being a fantastic buying opportunity, the market implied value growth was actually zero. The S&P 500 traded at its earnings power value, traded at current earnings, capitalized by the discount rate. One of the great buying opportunities of the last decade. Now it's tougher. It's really tougher to see. So from this metric, you would suggest that the market is potentially overvalued. What's interesting, I'm going to just walk through, just mostly because I want to keep the schedule on time. I'm going to walk through a couple of very quick case studies using this metric. We can see. All right, so here's Chipotle. I'm just, sorry. Chipotle, here's their earnings power value. It's very simple. I just took the most recently reported quarter, LTM or annual, and then LTM is through the third quarter. And then I just capitalized by a discount rate. In this case, I used 8%. I don't think 7 or 8 or 9 is going to matter that much. And you can see that over time, the earnings power value has increased. They've done a pretty good job, particularly recovering from the norovirus in 15 and 16. Interesting that the LTM earnings power value is actually not much higher than it was in 14 or 15. And oh, by the way, in the last 12 months, they haven't paid taxes. So that's an inflated earnings power value. If you then, we want to go look at the next part of it, the green parts, right? That's earnings power value. That's then your market implied value of growth. And you can see in something like Chipotle, coming off the lows of 17, the earnings power value has increased by 5-fold. That's why the stock has been so incredible over that period. You're seeing the market implied value of growth going from $9.5 billion to 45, almost $46 billion. And think about this, the green is investors' expectations of future cash flow for Chipotle. Now, Chipotle is pretty back close to its peak profitability. Current earnings are overstated because they're not paying taxes. They lost some money in the middle of COVID. So the earnings power value is overstated. The market implied value growth is probably a bit overstated. Numbers look big. Here's the market implied value growth just on its own, scaled back to zero, so you can see the magnitude. But this is the part that's most fascinating to me, is this is the market implied value growth for Chipotle as a percentage of the enterprise value. And so these stocks look expensive if you look at them in nominal dollars. But in fact, they're no more expensive than they have any time in the last 4 or 5 years. And I think this is the semi-paradox that goes on. The S&P 500 looks like it could be a bit overvalued, and yet individual stocks are no more overvalued today than they were maybe 5 years ago. Here's Apple, similar set of charts. I simplified, I'm just going to show you a few. They've done a good job of increasing the earnings power value. What's interesting is the earnings power value was fairly stagnant 18, 19, and 20, and then increased profitability, some reacceleration, really probably pandemic purchasing has increased the earnings power value to over $1 trillion for the first time. And the first time we've seen growth in a while. There's your market implied value of growth. This is it just as a standalone. You can see, back when Buffett was buying this 15 and 16, the market implied value growth was almost zero. His bet was that steady state business would continue. He wasn't betting on growth. And investors have decided that Apple is a growth company rather than just a steady state company, which I think is interesting. And you can see it on a valuation perspective. As low as 6.5% of the enterprise value in 15 was based on future cash flow growth. And now we're above 50%, down a little bit in the last 12 months versus the end of fiscal 2020, which was last September, a year ago. There's your S&P 500 average. So for 15 years, Apple traded at a discount to the S&P 500. In the last 2 years, it's traded at a premium, which is effectively the market believes that cash flow at Apple are going to grow faster than the economy. In a market that's growing probably no faster than the economy. Interesting bet. And then one more I'll run you through is Amazon. Here's Amazon's earnings power value. A bigger focus on profitability at Amazon than what we've seen before. Certainly AWS getting big enough to really drive overall cash flows has been very important. Small relative. There's your market implied value growth. There's it as a standalone basis. And you can see that dramatic increase in the market implied value growth for Amazon over the last couple of years, almost a doubling from 19 to 20, partially continued growth, pandemic play, as well as a bit higher profitability. But we're paying more for the future cash flows at Amazon than ever before. Although as a percentage, it's cheaper than it has been at times in the past. So I'm just trying to give you a little bit of a sense. What I said to Jim is there's a little bit of a paradox in the market. The market looks like it could be a bit overvalued, particularly if rates tick up. On the other hand, when you go look at individual stocks, they're essentially no more expensive than they were at other times in their history. In fact, you could argue that Amazon's a bit cheaper than it has at various points. Really, the takeaway here is to think about growth as a separate part of the valuation. And this is some additional work we're doing. We're doing additional case studies and all of that. That I think is the end of the formal slides. Love to take any questions people have. Now they type them in the. I think they send that a button. Yeah, hold on a sec. Yeah, there's a Q&A button if you want to ask questions. Great question. Great question. Almost all the work is capital structure neutral. And what we do is we essentially, when you look at NOPAT, it's without interest income. And we look at enterprise value, we're essentially neutralizing the debt. So it doesn't misrepresent. There's a subtlety here that's really important. And that is that it's the market implied value of NOPAT growth. So it's not just revenue, it's revenue and margins. So if you actually thought margins were expand, that's a lever on top of your revenue growth. So keep that in mind. This is cash flow growth. On a leveraged company, when you do a financial leverage company, when you're using financial leverage, then you can actually get even faster cash flow growth than you would get revenue growth because of the leverage. So it doesn't misrepresent growth for highly leveraged companies as long as you're focusing cash flow growth, equity cash flow growth, or NOPAT growth. Any thoughts on how MKT implied value growth differs in Europe, Japan versus US? Structurally lower. Yeah, I haven't done as much work, but yeah, it's structurally lower, which I've always been fascinated. I've done a little bit of work with the Canadian market. And the Canadian market always trades at a growth on a growth base, always trades at a discount to the US, 10 to 15%. Not 100% sure why, although it's a less sophisticated capital market for sure. But yes is the answer. It's structurally lower. I haven't done as much. Which due diligence do you when valuing your growth stock? This is where it gets a little tricky. Jim said keep your discussion to 15 minutes and then have some Q&A. There's another 45 minutes on what you can do once you have these numbers, but it's kind of fun. So what you realize in Amazon, Chipotle, and Apple, I just picked those three. We've done probably 20 of these case studies, and we're doing more all the time. The only thing that matters is growth. I mean, literally the only thing that matters at Amazon is growth. And you have AWS and you have, we'll call retail, but non-AWS conglomerate of mostly retail. And you have to go look at truly the growth metrics. In these high value companies, the only thing that matters is growth. For Chipotle and Uber, and we just go through Facebook, Netflix, all of that. Netflix, it's just subscriber growth. You can take it all the way back. Chipotle, the only thing that matters really is the number of stores that are opening. And there you really care about is ultimate penetration. So you got to go look at that. On something like Apple, it's, I think, really fascinating because they're in a market that's not growing that fast. Their primary market is clearly cell phones, smartphones. And in that, once again, now what I like about doing this analysis is that once the marketplace value of growth gets above the S&P as a percentage, you realize increasingly the only thing that matters you got to get right is growth. And so you can spend all your time thinking about all these other things, but at the end of the day, it's that growth, incremental growth, that's going to drive the stock. All right, I'll take some more questions, but probably give it back to Jim. Oh wait, one more question. Do you know what percentage of negative profit coming from market has changed over time? Yeah, Victor, this is a great question. So much longer answer. I'm going to give you a very brief answer so we can keep the conference going. Happy to talk offline. But the percentage of negative profit in the market has changed over time. It's much higher today than today, meaning the last 5-7 years. It's much higher than it's ever been before. In fact, one could argue, other than the dot-com bubble in the late 90s, we've never had a period like this before. And investors are really, you take something like Uber, it lost $4 billion this year, and the valuation is huge, but people really do believe, or willing to believe, investors are willing to believe that once you reach scale, you'll be wildly profitable, because the thought is that's what we saw on Facebook and Google and things like that. It's not, I think the analogy isn't there. I think it's be difficult for them to get there, but yeah, people are very much focused on top line revenue growth as a proxy of future NOPAT growth as a consequence. So yeah, I agree with that. All right, Jim, back to you.
Great, thank you, Paul. Great high-level view from Paul. And if you like his stuff, he's got a great book out. He sold loads of them, actually, too many of them. And if you can sell too many, it's called Pitch the Perfect Investment. If you like that sort of stuff, you like Paul's teachings, go buy his book. I bought it. It's great. He's about to drop another book, actually. Is that imminent, Paul? Or
yeah, it's called the same title as the presentation, The Value of Growth, but it won't be out until next year.
Okay, fair enough. So he's got another one cooking. But yeah, it's a great overview. Now we're going to go slightly bit more micro. I'm going to bring in David Marcus. Now, David, like I say, he can tell you how long he's been around, longer than me for certain, but absolutely a stock picker at his finest. And he'll tell you more, but he concentrates on situations of special situations that change the stocks through corporate events or anything like that. I can tell you a little bit more, but I think today he's going to talk about conglomerates, and we all hear this term conglomerate. Actually, it's so topical at the moment because what you're seeing is conglomerates breaking up. You've seen the GEs, you've seen the Johnson & Johnson, things like that, and you kind of look at yourself and you say, well, why are they breaking up? Well, what's the reason, and why is it now? And David's an expert on looking at those conglomerates, and he's going to talk a little bit about that, I believe, and really dig into what he's saying. But David, I'm going to hand over to you.
Thanks, Jim. Really appreciate it.
I don't think we can hear you.
You can't hear me. It's very weird. Hello? Can you hear me? Can you hear me now?
Yes,
we can. Yes, we can.
Okay, great. Well, thanks, Jim. I appreciate it. Thank you for having me back. It's always great to be part of your events, but especially this one, which is for an incredibly worthy cause, the Alzheimer's Association. And so I am excited to be part of it again. So my focus, I've been focusing on special sits virtually my whole career. I was lucky enough to start working for Michael Price at Mutual Series Fund back 1,000 years ago in the early 1990s, and really just learned all about how to look at companies that had tons of parts. And I've continued to do that over the years. But what I learned as well as things went on was that it's not just conglomerates and holding companies that are interesting. when they're going through breakups, spinoffs, restructurings, transformations, all kinds of things, always looking for value plus catalyst. But many times there are people behind these companies. They're not just corporately controlled where you just have a board and management who can come and go from time to time. You have individuals and families that control companies globally, but especially outside the US. There's sort of an ongoing abundance of conglomerates and holding companies. So where the market has always seemed to value conglomerates with a conglomerate discount, you could look at Berkshire Hathaway all the way on down. There's always some implicit discount because of the variety of different businesses. The reality is that conglomerates are not a bad thing. It's just that sometimes they're poorly managed. And so you have to really understand it. Though I will say in the long run, you find that many times conglomerates may be valued at their weakest link, meaning even if they have a small business, that's a small percentage of the whole pie, sometimes the market will value the whole thing at that level. That's why it's exciting when they start to peel assets out. Because when they peel out that low margin, low growth business, the market's needle goes to the next worst business, and then the next worst, and then the next worst. So when there's dynamic change going on, it's really compelling. I'm going to share my screen now. I have maybe the shortest presentation of the day in terms of actual slides. Bear with me. Share screen. There we go. Okay, let me go back to the beginning. You guys can see that, right? I'll just assume you can.
Yes.
So I'm focusing on, as I say here, special situations within family-controlled companies. And just a quick definition, I realize there's so many ways people define family-controlled businesses. We don't let this thing bog us down. We're looking for companies where, let's say, an individual, a couple of people, a family, a group of families control roughly 20% of the company or more. But we don't get bogged down if it's 19%. It's about, do they determine the course of the business? Even if they've hired professional managers, is it the tenor and tone from the tempo from the family that sets the pace going forward for acquisitions, for how they take care of the shareholders, all of those kinds of things. So we're looking for where there's real control and domination. I was lucky to work directly with a Swedish family that had a big conglomerate, who was my partner in the first fund that I started 22 years ago. And when the patriarch of that family passed away, I ended up going on boards, helping them restructure companies. But I got to see the inner workings of how these conglomerates work as they look to create value for themselves, but then they let the shareholders tag along. And so that's the question. Are they working for you or against you as the shareholders? Are they value creators or are they value destroyers? So just a quick back sort of little history, not history, but sort of what we're looking at. I just touched on a few of these things. Basically, it's getting to, it's all about people. Let's cut to the chase here. It's all about people. Businesses don't run themselves. People run businesses. You have to make a judgment call. The judgment call sometimes it's as important or more important than the numbers themselves, because you have to bet on these people. So meaning we think about horses and jockeys, right? The horse doesn't know how to run around it knows how to run. It doesn't know what to do though to win the race. It needs somebody to guide it and to control it and to manage it. That's the jockey. So we're thinking about who the jockeys are and the value that they can bring to the table. So here we talk about good stewards of capital. The family is the biggest beneficiary. They own 40, 50% of the company. They announce a bonus dividend. They get 40 or 50% of that whole payout. So they're doing things to benefit their own interests. But as I said, they let you tag along. That's my bottom bullet point here, ride the coattails. Now, I've seen situations where families are viewing the public vehicle as their piggy bank. They will just use it. They'll put assets in, take assets out. Yeah, you got to stay away from those because those are value destroyers, or at least you don't know what you're getting. And you just don't want to deal with people where you can't trust what they're doing. So that's why we spend so much time vetting the managers, getting to know the main shareholders. We really start at the top and work our way down. Many people on the street start sort of in the middle. You call the IR guy and you're slowly working your way up. I go the other way. Who's the largest shareholder? Who's the chairman? Who's the CEO? We start as high as we can and you work your way down, because we're really trying to just cut to the chase. Is this something of interest to us? So, as I say, value creators, value destroyers, owner operators tend to think about long-term value creation. They're not thinking about quarter to quarter. And I list here on the side, as I said earlier, breakup, spinoff, transformations, asset sales. Liquidations can be great investments. I think Klarman did an interview once where he said, you know, liquidations have been some of the greatest investments that they've done over time. Most people hear the word liquidation, they run, they want to get away, they think fire sale. But sometimes they're just breaking up a company, a conglomerate, a holding company, doesn't need to exist, or there's a family fight, and the underlying businesses are growing. So this is just a little smattering of holdings that we have had over time or currently have in our portfolio, just to show that you have family-controlled holding companies or operating businesses, but most of these are holding companies in some way or private equity businesses, and where you have a main owner or a tight group that really treat it like, you know, for themselves to create value. They can be found globally. For us, we do focus, even though our fund and our business is focused on global special situations, the reality is we focus in Europe more than anywhere else. We tend to find more things in Europe. But as we expand to other regions, we really have found family fights. The next generation doesn't get along with each other, brothers and sisters fighting. One company in Japan, the son tried to kick the dad out of the business. These things can create lots and lots of value. Just to keep it tight. So I like to, so FCCs are family controlled companies. They can fall into various categories, but they almost all have the same focus, the ones that we focus on at least, where we're betting on them as value creators. The ones where we think they're value destroyers, yeah, we're not betting on them. We're not betting against them. We're just staying away. We're not looking to short them. We're looking for things that we can put money to work in, and sort of let them do all the work for us. The hard part is to really do all that prep work, understand what you own, why you own it. I lay out here the different kinds of the family control businesses. The first line you see, it says classic. Even though I call it classic, let's look at, I'll just touch on a couple of these things. Exor. Exor is the holding company for the Agnelli family, in Italy. The head of the family these days is John Elkann. He's in his mid-40s. He took control when he was in his late 20s. His grandfather had anointed him as the heir to take over. This guy's been an incredible value creator. And he's transformed what was a dying conglomerate, which was basically fiat. And he acquired, thanks to his really hiring Sergio Marchioni, who's unfortunately passed away a couple of years ago. But Sergio was an incredible businessman, and John Elkann just unleashed this guy. What John does that's so great is that he understands he doesn't have all the answers. So he hires great people and he lets them do their thing. They bought Chrysler from the US government during the financial crisis. That gave him Jeep and all the other Chrysler product lines. Today, it's a monster cash machine. In spite of the supply chain backup and all of that, the reality is it just cranks out cash. So they are a holding company, and then beneath them they control Stellantis, which is the holding company that owns a variety of their auto businesses. As I said, Fiat, Chrysler, Peugeot they merged with recently. They have stakes in Maserati and Ferrari. They own Partner Re, which they've announced they're selling. So I've run into John a couple of times over the years at the Berkshire Hathaway meeting. He's very focused on this sort of conglomerate and compounding and delivering long-term results. Where he's different from Berkshire is he will sell assets. He will absolutely sell businesses. They bought Partner Re a few years ago. They're selling it now for $9 billion. It'll make them flushed with cash, and they'll have an incredible war chest to make all kinds of new acquisitions. He's slowly evolving that conglomerate to be focused on luxury brands. So they recently bought 24% of Louboutin. That's the women's shoes and accessories He wanted to buy more. The family that controls that company is sort of, slowly letting outsiders in. They got a couple of board seats as well. So I call this section classic, but the reality is they're very dynamic. I call it classic because they're just good at compounding the net asset value over long periods of time. Bolloré, it's the 7th generation of the family is running it now. The 6th was the one that I started to get to know back 25 years ago, Vincent Bolloré. He is like a vulture investor. He went after Vivendi when nobody cared about Vivendi, when it was going through a lot of problems, took control of it. His family controls it. Vivendi controlled Universal Music, which they recently spun off to shareholders and sold the stake to Pershing Square, 10% Pershing Square bought. They sold the stake to Tencent. It's been a home run for them, just restructuring, evolving the conglomerate. So, and he's handed it off now to 2 of his sons who are running. One runs the family company, Bolloré. The other one is the chairman of Vivendi. So they have 2 conglomerates going at the same time. It's fascinating. And so you can see all kinds. You have Guaco Group. They have huge assets throughout Asia, in Malaysia, Indonesia, Singapore, Hong Kong. Incredible. We got to know that family over the years. We really try to get to know them. The head of that group is a man named Kwek Ling Chan, though he's recently handed control to his younger brother, Kwek Ling Hai. Just, it's in their DNA. And again, you kind of tag along. I will say a few years ago, they tried to take it private. We did not tender our shares. Our view was, hey, we want to invest alongside you, not sell to you. Then you have companies that are M&A focused. So I note 2 here. We currently own both of these. Storskogen, which is a Swedish holding company. It just IPO'd a month ago. So it was a private company before that. They're sort of a roll-up of small businesses. There's some quirk in Sweden where the market there falls in love with roll-ups more than at any other place. So when they're good at rolling up businesses into these conglomerates, the market really rewards them with ridiculously high multiples. We did come in the IPO. It's up nicely since then. But Daniel Kaplan, who's the founder, they've acquired 150 businesses over the last, call it 12 years. Lifco, another Swedish conglomerate, started by a guy named Carl Bennet. Carl is probably one of the top 3 or 4 richest guys in Sweden. I first met Carl in the 1990s. He was not on any rich list. And he bought a division out of Electrolux, where he worked with another guy. That became a public company called Getinge. It does, they sterilize equipment for operating rooms and so forth. In any case, that Getinge business today is a multi-billion market cap. He's still the main owner there. Lifco, this is the best investment we made in our fund in terms of total return. It's a stock that not one shareholder has ever asked me about. It's up 12x from the IPO. They've acquired a few hundred businesses over time. They're very disciplined. They're looking to take control of companies that are family controlled or just have a good sort of family controlled mentality. Good businesses in the dental space, robotics. A lot of that is for demolition robotics. All kinds of interesting businesses. I'm not going to take you through each one of these because we'll be here all day. But the point is that I just lay it out here to give you a sense. We look at something like KKR as tightly held or family controlled because Kravis and Roberts control it. I know they just handed it off to the next generation, but the insiders control the company. You kind of want to own, with private equity, you want to own the private equity business. They might be good at managing money for people, but you want that tolling every year of the management fee, and then you get the bonus of pieces of the performance fee. I mean, they raised $60 billion last quarter, in 1 quarter, in their new products, and they seed it with their own balance sheet. So you, as an investor, since they're deploying their own capital, you got your money in the fund with them as an investor, and you own a piece of the business. And just quickly breezing through, you can, and I'll give you I have kind of 2 picks that I'm going to highlight out of this, but basically you can find restructuring cases where I'll look at Zim. So Zim is an Israeli company. It is a container ship business. Zim is controlled by Kenon Holdings, Kenon, trades on the New York Stock Exchange. Zim is Israeli, but only trades in the US. They IPO'd back in January. It's controlled by something called Kenon. Kenon is controlled by Israel Corp in Israel. That's controlled by a man named Edan Ofer. He's, I think, the richest man in Israel. And so in any case, Zim was I'm going to just use a 4-letter word, but I'm going to make it longer than 4 letters. It was a crappy managed business for a long time. And in 2017, they brought in an outsider to clean it up, turn it around. And a guy named Eli Glickman, he came in and he said, I know we're a shipping company, but why do we own ships? And so he sold all the ships. They transformed the way they ran the business. They went asset light, leasing ships for very long term and then chartering them out. But he also brought in technology. This may be the most advanced company in the shipping space, especially container ships, in terms of digitalization. They really have transformed how things are managed, and they just have, when they IPO'd back in January, the stock was 15, it's about 50 something today. We think it's still grossly undervalued. It's a cyclical business, I get it, but the reality is that this is one of the best beneficiaries of the supply chain plumbing backing up, is container ship businesses. And so something like Zim, that is one of my picks. I think it's grossly undervalued. They announced yesterday they're going to kick off a $2.50 dividend per quarter. That's $10 a share for the year. The stock's a little over 50. They paid out a bonus $2 in September. They just IPO'd at the beginning of the year, as I said. When they first were coming to the market, they had forecast 1 billion and change of EBITDA for this year. Yesterday, they upped their guidance to north of 6 billion for the year. So normally shipping companies do not have net cash. This one does. They usually are very levered. It's like having a portfolio of real estate. You're not going to just be, you're not just going to cash pay it. You're going to use the bank's capital to help you leverage your assets to grow your empire. So Zim has accelerated the payment of all their debt and has net cash today. And even as rates come off the highs, we think this is a money machine. And as I said before, it's ridiculously well managed. So that's my one pick. My other pick is IAC. IAC is Barry Diller's company. What's great about what Barry Diller has created. Now, some people don't like Barry Diller. Some people love him. He's very well paid. But you know what? We're making a lot of money tagging along with him. So IAC is one of these great, think of literally owning a money machine. What does he do? In 1995, he acquired, I think it was called Silver King Communications. It owned 12 UHF channels. Well, he took that base and he built QVC. They took control of home shopping. He kept kind of using that as a base. But what the brilliance of what he and the CEO, Joey Levin, have done is they find businesses that have scale, huge market potential. They're probably undermanaged. They need capital and they need good stewardship. I think it was 1999, they bought Match.com for very modest price. They nurtured it. They pushed it. They grew it. And so by the time they IPO'd Match a year ago, I think that it came to the market with an 11 or 12 billion market cap. It was an enormous rate of return. So they build, they scale up, they nurture, they grow them, and then they spin them to shareholders. So you're buying the stock, eventually you get these spin-offs. Since we've owned the stock I think about 2 years now, we've gotten 2 spins. We got Match, and then we also got Vimeo, which I noticed the Alzheimer's video was on the Vimeo platform. I mean, it's an incredibly high growth business. We did not keep the spins. I want to own the money machine, and then over time I've sold the spin-offs. But the key is those 2 stocks, I think, really showcase it. And if you kind of go back to the history of IAC, just to show you what kinds of businesses that they really have created over time, they created Expedia. I mean, they didn't create it, but they built it into something that became exceptionally good. Expedia, TripAdvisor, Home Shopping, Ticketmaster, which today is Live Nation. So their efforts helped transform these. Why is it so compelling right now? Why is today the call to action, even though it's done so well? I'll tell you why. They just announced their largest transaction ever. They acquired Meredith Corp's print media assets. What does that mean? Well, what that means is they're acquiring People Magazine, Us Weekly, Better Homes and Gardens, and all kinds of other magazines. Meredith was probably the best at running subscription businesses. Go to any of their websites for these magazines and others that they control, they're not good. So what IAC brings in is the knowledge. They bring these businesses in, they transform how they're managed. The cash flow generation, we believe, that can come out of Meredith Corp is incredible. And the company made that acquisition. It was I don't have the number in front of me, but I think $2.5 billion, give or take. They're using debt and equity and cash, and not equity. And they'll still have a fair balance sheet, very strong, a lot of cash, and they're looking for other deals. You know, at the depths of the pandemic, they bought a big stake in MGM. Why? At first, it looked unusual for them, but then you realize that it wasn't the live casino business, it was the online business, BetMGM, which was, let's say, okay managed. But when you have 35+ million people in your loyalty program, you got to milk that. And so with that stock's more than doubled for them. So they've more than doubled their money already there. They really do take this thoughtful approach of this sort of taking advantage of online and related businesses and things that can be scaled up, as I said before. Before I wrap up and maybe turn it up over to Q&A, I'll just say the one area that I always find the most fascinating, just because there's always an opportunity, it's just that they don't come along that often. Family Feuds. Family Feuds. So you see Universal Entertainment here. That is not Universal Music. This is a Japanese company that was started as a pachinko machine servicer and manufacturer. Eventually, Mr. Okada, who was the founder, met Steve Wynn, and he was basically Steve Wynn's initial backer for the Wynn Resorts years ago. At some point, Universal became so enormous. A lot of it was because of their investments in Wynn, because they made so much money. They decided to build their own casinos in the Philippines. And what happened? They had a falling out with Steve Wynn. So ultimately, Wynn seized the stake in the company. They had litigation for years. The net of it all is that we learned that in the Japanese market, there's sort of no affinity for litigation plays. So the stock collapsed. Meanwhile, you knew you were going to get billions of dollars in recovery. It just was a question of when and was it going to be 2.5 or 3 billion, or was it going to be even much larger? They eventually got the recovery. The stock did incredibly well. And then Mr. Okada was attacked not physically, but by his son, who decided that his dad no longer should run the business. In Japanese public companies, you don't normally see these kinds of family fights rolling into the street. The son got his sister to align with him. They kicked the dad out. They accused him of self-dealing and other things. Make a long story short, there was a lot of finger pointing. Did he misappropriate 20 million? This is a multi-billion-dollar company, but hey, if there's fraud, there's an issue. And the net of it all is then the sister realized she didn't want to support the brother. She wanted to support the father. So there was a lot of stuff going on. We stayed through part of that. And as I say, we had an incredibly good total return. But ultimately, the feud just never, it was like the Hatfields and the McCoys. The problem was it was the Hatfields and the Hatfields. It was like it was all in the same family. And it really, we got to the point where we decided to move on. But to the one to the left of it, WBL, you had two families in I'm drawing a blank here, but basically you had two families in Singapore, the Lee family and the Tan family. And the company was built with real estate. It was a conglomerate, all kinds of things. At some point, the third generation decided they had disagreements with what the future should be with each other. And to cut to the chase, there ended up becoming a bidding war. Almost every other day, you'd see one family topping the other, calling us for our support. Which one should we sell to? Oh, we're just here to make returns for our shareholders. The Tan family, which was not the largest owner, crept up, took a big stake. And at the end, we concluded the Lee family just didn't have the resources to keep upping their number. But in the market, the stock shot way over the bid because they just kept outbidding each other. We sold it into the market. Eventually, the Tan family won. And you know, it's part, they're part of the Straits Times conglomerate as well. And that's it. I mean, I could talk about all these all day. I mean, Vivendi just spun off Universal Music, but I guess I'll stop here because this is when I usually start blabbering. So Jim, I'll turn it over to you, or questions or any.
Absolutely, Dave. That's fascinating. And you know what I get about you every time I speak to you is the passion for the people who run the companies. I mean, it's something that we do a lot more these days, where, you know, numbers become not irrelevant but slightly less important on some of these stocks. It's who runs it, you know. And we're going to come up soon with Barrington, who look at these companies from that sort of standpoint. You know, good businesses that could be improved to, or good businesses that are not good anymore, maybe can be improved. So we'll come to that in a second, but I want to keep this quite short though, David. We've got 4 questions down there in the Q&A. If you could, can you see those? If you could blitz through those, then.
Oh yeah, so
you got those?
Or the competitors to Zim. We have, well, it's container ships. You have a Norwegian company, MPC Containers, though they do more of the smaller containers. You have Hapag-Lloyd, one of the largest players in the world. You have Maersk, the Danish company. So you have very large players. It's what Zim has focused on is Fortune 100 companies. They have an exclusive arrangement with Alibaba, for example. They really focus on who are the big boys, and that's who we want as our partners. We don't want any credit risk. We just want to run this thing out as well as possible. And so what's nice is that in the last few years, because there was too much capacity in the industry, basically these container ship companies stopped ordering new ships, at least at the quantity that they were before. So as you have the pent-up demand coming back and coming out of the pandemic, there's not enough capacity of ships. Forget about the backup at the port. That's another issue. But they are getting record rates on the day rates or the charters. But the key is there's enough for everybody, but these guys are probably, I would imagine they have the best margins. Again, they don't own the ships. The other companies own ships. 2 weeks ago, they bought some smaller ships, feeder ships, to feed the larger part of their business. And we think ultimately they could even leverage their technology platform into other markets and license it out. It's really compelling. But you do have big players, and Maersk has gone through restructuring after restructuring after restructuring. And right now the container side is working well for them. Hapag-Lloyd is the product of 3 mergers, one in Egypt, one in Chile, to become, I think, the 5th largest player in the world. We once owned Hapag-Lloyd. It was an incredibly good investment. And so this whole area is a really good area. You don't have to only own one, but we just love the way Zim is managed and who runs it and how they run it. And again, it has that family DNA.
David, thank you. Just grab one more question there, because I know you're going to stick around, and we've got a few more, but just grab one more there. And I want to move on to Jim, who's waiting. But if you just ask once more, then we could ask a few later, because I know you're passionate about this. And
okay, I mean, there's a bunch of questions here. I'll just look. Grenke in Germany, I know there's a lot of issues there. That's a very longer conversation. I don't know it that well. We've just stayed away. Whenever we see those kinds of issues, we stay away. Berkshire, personally, I've been a shareholder for 25 years. I'm pissed at myself that I didn't buy it in my fund when I launched the firm. It's been great. I've gone to the meeting 21 years, except for the last couple with the pandemic. People, your question is about, will the stock go up if Buffett passes away? I just think back to what Buffett once said. He's like, he finally admitted a lot of the deals go to Berkshire because of him. And I just think that the market will have less patience with everybody else at Berkshire after Buffett and Munger are not here. I'm not selling what I own personally, but the reality is it will not be the same company after, though he has trained these guys well. They seem to have a lot of the DNA, but as we've seen with every transition in family controlled businesses, the next group, whether professional managers, kids or grandkids, they bring their own style to the case. And so I think that will slowly evolve here. That could be very good for shareholders. It could be bad. You just don't know yet. I would sit back and let it ride. Why? Because it doesn't change overnight. The market's perception might, but the reality is nothing will change in the business for a long time. Thank you.
Great. Thank you, David. I know David's going to stay around, so he's going to pick up some of those questions later. And that's the problem with David. He's passionate about what he does, and he believes in what he does. So he likes to share his knowledge. So thank you for those questions. If you could unshare your screen, David, that'd be great.
Good question, if I could. No, I got it. Thank you.
but so that moves on to our next guest today. Now, David's talking a lot about companies and performance, and we're hearing a lot about that. But, you know, as a shareholder, sometimes, you know, you don't really know what's going on behind the scenes. You don't know whether the management are making their best decisions. You don't know what could be improved. And we've had a new, I say new, I mean, activists have been around for a long time, but they've been more active, I would say, in the last 2 years. And at the Edge here, we look for companies that are maybe due for change in terms of maybe management, maybe operational performance, maybe spin-offs. And we try to find those ideas for our activist clients as well. But I want to introduce James Mitarotonda, who's CIO, President and Chairman of Barrington Capital. And he will give you a background of what he does and what their firm has been in the market in the last few years. But Jim, you know, one mind saying, I've known Jim for a while now, and the more I meet him, the more knowledge I get off him. And so this is a real life activist who looks at companies for potential improvement, and they've often come, you know, with a bad name, really, like, you know, they're just getting in the stock so they can make money and then dump the stock. But I don't think, well, I know Jim's firm isn't one of those firms that do that. They're after real shareholder value. And, you know, you hear a lot about shareholder value today, and the word is branded around a lot. But Jim, I think, is truly a creator of that value. So he's going to give his view on the activist space, what he's been up to, and what he's looking at now. But this is a real insight that you don't normally get. So I want you to take take everything he says down and see if you can use it for your advantage. So thank you for joining us, Jim, and I'm going to hand it over to you. I think we're lacking in the sound there, Jim. I don't think we can hear you. We still can't hear you. No. No, we still can't hear you, Jim. Joys of Zoom here. Okay, well, maybe you got a headset, Jim, or we could go back to David. We could ask a few questions while you're getting ready there. David, are you still around?
Yes.
Fantastic. Fantastic, man. Thank you. While Jim's getting ready, do you want to answer a few of those questions that come through there on the back of, you know, a couple of the attendees there? And
I thought I got them. One was the Berkshire, one was Grunke. I just don't know well enough. What am I missing one? I'm not sure I see it.
You got to go into Q&A.
Yeah, on the side in the chat, right? Yeah.
Yeah.
No, not
Yeah,
chat.
Berkshire Hathaway I mentioned. Grunke and
No, not on the chat. On the Q&A, there's a Q&A button down there.
Oh God.
Yeah, it's all technical.
A Q&A. Okay.
Jim, can we hear you?
Right.
We'll carry on with David for a bit until Jim gets sorted. That's fine.
You know, when I hit Q&A, it's pulling up this chat box with these questions. If you just
Okay.
ask me the question, I
I'll
can
ask you. It says,
Can you hear me
Oh,
now?
wait, I got it. It just popped up somewhere on the screen.
we got Jim. We've got a clash now. We got Jim back on.
You got him on. I'm
We're going to
out.
mute you again, David, and save you.
Okay, Exor we'll talk about next time. Take care. Good
We'll
luck.
come
Jim.
back to you, David.
Hey, Jim, how are you?
I'm very well, thank you. Thank you,
Thank you for
Jim.
that. Yeah, well, like I say, you got the introduction. Why don't you just tell the audience, I guess, what you do?
Sure.
You read my introduction, and if I got anything wrong there, smack me. But
Well, Barrington has been around for some time. We've been an activist fund for 21 years. When I started the fund, actually, I didn't even use the word activist. I said that we would be very actively involved in the businesses in which we make investments. And that's something that I believe all investors should be doing. Because as part owners of companies, we should be very actively involved in the businesses in which we make investments through, of course, the board and voting and the board's choosing of the right CEO for the company and the right culture, of course, and the right strategy. So that's been our approach to investing. And we've worked with companies, about 100 different companies collaboratively, sometimes behind the scenes, sometimes a lot more visible. A few times, I think it was 7 or 8 times, we did engage in proxy contests where we did add people to the board. The recent past, I would say, has been a lot more behind the scenes. Like this past year, we did make an investment in Textron. We made an investment in Standex, both of which have worked well. And we worked very much behind the scenes with them. We did make an investment in Rambus that I am on the board of directors of and have been since the beginning of 2021, early 2021. And I think there's tremendous potential in that business as well. All businesses that have done well. I think that I would like to start because 3 years ago, as you obviously, Jim, and maybe some of our viewers as well, I did present at the Edge and I presented L Brands. And I did a whole presentation, which we did include in this presentation exactly the way. There were no changes to it. I just included the same presentation just to see what happened from the presentation that I did at the Edge 3 years ago. And it was November of 2018. And at the time, L Brands, I'm not going to go through page by page. I will just give a brief overview. But at the time, the stock had declined considerably. It had, it was negative for 1 year, 3 years, 5 years. And we felt that a lot of that was self-inflicted, especially, of course, and predominantly at the Victoria's Secret business. Bath and Body Works is a superb business and was a superb business 3 years ago. And it's gotten even better now. And I think it will continue to outperform everything. And when you looked at Bath and Body Works at the time and compared it to like Ulta, for example, you were getting Victoria's Secret for very, very, very low cost, if, in some cases, depending on what you factored in, for free. And that's a business that was generating $6 billion in revenues and 40% of the market share in the US. But yes, it had underperformed. It was performing poorly because of management missteps, exiting some businesses like the swimwear business. The marketing message was outdated, and it really started to perform really, really poorly. EBITDA declined from close to $1 billion down to $400 million. It's now back up to about $1.2 billion. And we felt that if the company separated the two businesses, that would create a lot of value for shareholders. And of course, you needed to implement operating improvements as well. And I think that's something that we've always been involved in, because we look at activism as a complete package, as capital allocation, of course, governance, now, of course, ESG. But governance has played a big part in what we do through, of course, the formation of the board of directors and the way board of directors looks at companies in the best interest of shareholders. And of course, operating improvements. So operational, it is something that we do. It is part of our culture here at Barrington. It is part of our background. We have lots of operating people that have been quite successful in running businesses. We think that makes for successful businesses, not finance people. finance people obviously serve the purpose within the companies, and obviously all of the other attributes that we bring, but it's really operating people that make for successful companies. And we felt that that business had tremendous potential, but it needed to be separated and it needed to be operated differently. And we did engage with the company. We did issue a public letter. We did engage with the company, and we entered into an agreement with the company in March of 2019, where we became an advisor to the company. I became an advisor to L Brands as an insider at the time, so it was no different than being on the board of directors. We didn't trade, of course, but that's not our approach anyway. We're typically 3 to 5 year shareholders. There have been a couple of companies where we've been shareholders for 10 years, and some companies shorter because they were acquired, or the stock, of course, appreciated considerably, and we decided to exit. So we did enter into an agreement with the company. We worked very closely with the company. I have to say that it has been a superb working relationship, both with the board, with Mr. Wexner, with the management team of each of the two businesses. We continue to be an advisor to the company. We continue to be shareholders of the company. And as you see, the stock has appreciated considerably during the last 3 years. And the numbers that we provided, for example, on that page, that shows a 270% in the graph, that did not include today. Numbers were announced after the close yesterday on both businesses, and they continue to do well, even, of course, in this very challenging period of inflation and raw material cost increases and supply chain issues. So even with those headwinds, the company continues to outperform, and we think they've got tremendous runway ahead of them in the coming years. I won't go through anything else as far as L Brands is concerned, and I'm going to just skip forward to the pages. Everyone can have an opportunity, of course, to look at these pages, but there's no sense to really go through that. By the way, this is what we said 3 years ago, and we felt that we could get to even higher 64, depending on the operating improvements. And we pointed that out, of course, both with the company as well as the public letter that we issued. But this is what we said 3 years ago on the 27th of November at your conference. So it's been quite an achievement, and we're quite pleased with what has happened. Let me speak a little bit about activism today. Clearly, it's here to stay. You know, people ask, is it a fad? Obviously, it's not a fad. Some years ago, people asked me at an OPERS conference, is it a fad? Is it something that is just temporary? And of course, my response to that was that it is absolutely not a fad. And I believe someday we won't even have the word activism because everyone will act appropriately. It is something that obviously has had tremendous momentum and tremendous growth over the last 10 years. And I believe that it will continue to grow because it's an important part of investing. And when you look at activism, it starts in investing in the right company. You heard from David before on some of those companies that are exceptionally undervalued, obviously were at the time when they made the investment. And you look at the things that we look for. You look at the companies of some of the other activists, some of the ones that I consider outstanding, like Elliott and Jana and Starboard and Bill Ackman, of course, and some of the others. Clearly, it starts with investing in undervalued companies. So you need to have a real understanding of businesses. To me, you can't be an effective activist without truly understanding the business, because it comes down to, in order to persuade the board, to persuade management, to generate the support of other shareholders, we better understand the business and we better present a plan that demonstrates that understanding and is persuasive. And that's why I highlighted the word persuasive, because to me, that's key. We own a small part of a business. When we don't know, we're not private equity. We don't own 100%. We don't own 60. We don't own 40. We own a small part. So when I say we, I refer to all activist investors, all investors. And so with that, it's important, of course, to truly understand the business and present a plan that is compelling and is persuasive to the company, persuasive to other shareholders as well. The next step, of course, is implementing that plan. And that comes down to, obviously, building a real relationship, working with the company, being collaborative with the board, with management. And as I said, most of our investments have resulted in that type of working relationship with the company. I commented to someone a couple of months ago on that L Brands should be a case study in an activist working effectively with management and the board in the best interest of everyone. And that person said, there already is one, and I was not aware of it, but there was a case study that was put together by two professors at University of Denver. Of course, she did send it over to me. There's been an update to that as well, but there has been a case study that was put together. And as I said, we were not even aware of it because they didn't call us. They just looked at whatever public disclosures existed and wrote up the company and did a really good job, actually, in understanding the business and what happened. So it really has been a superb working relationship. And that's, to me, what activism is all about. There have been times, as I mentioned, where we did get to a proxy. And I think it's important to be able to do that because I think boards that resist that kind of involvement, that kind of shareholder involvement, which I think is a big mistake, in order to really implement the plan that we would feel and we feel very strongly about, I think it is quite important to be able to go directly to the shareholders and ask for the shareholder support in those situations. But there have been just very few and far between in our situation. And I think you're seeing that as I go to the next pages. I think you're seeing that not just with our company, but with every company. You look at Starboard, for example, you look at, Elliott, you look at some of the others. There's very, very few proxy contests that you see now because boards have started to really engage with shareholders more than they did in the past. And I think that will continue, of course, to be the case. I'm just going to switch to the next page. I've included in the next few pages just some recent information from Lazard's Capital Markets Advisory updates, which they do on a quarterly basis. And again, it goes to show you, while it's still a little lower than pre-pandemic levels, clearly it's starting to pick up, and you're seeing activism, not just in the US, but throughout the world. You're seeing different type of activists as well. Obviously, we've seen in the recent past some of the mega caps activists by some of the larger investors, like, of course, Third Point, that has done quite a few much larger companies. And you're starting to see a real focus also on ESG. And that's something, while we've been certainly big proponents of governance through the years, we've always included ESG, especially S, within the things that we do. If you look at many of the directors that we've proposed to the company, and we actually wrote a paper, one of our former partners, Jared Landau, who used to be our chief, our general counsel and COO, put together a paper about a year and a half ago on board diversity that was published by the corporate board. And we did talk about the involvement of diversity on boards. And diversity to us has always been diversity of gender, diversity of ethnicity, diversity of race, diversity of thought. And it really comes down to thought, because all those other things goes to the way you really what you bring to the company, your experiences, your background, and the way you would look at things. And I think it's important for boards to have that diversity of thought. And that's what we did some research. We, of course, researched many of the companies that we invested in as well. And I think you're seeing a lot of that now as well. And then, of course, as I mentioned, there's been activism throughout the world. You're seeing a lot of that now from Australia, Europe, and of course, the US. As I mentioned, you see here the number of board seats that have been added to boards by activist investors, as well as settlements versus proxy contests. When at the beginning of the year, as I mentioned, when we did buy a stake in Rambus and started to have discussions with the company did go through a process of adding directors, and they did add me to the board of directors of the company. And again, it's been a wonderful working experience. It's an excellent board with tremendous potential at the company, because the company actually has two businesses, has a licensing business that generates a lot of cash, and has a product business. And that product business is really starting to grow. Actually, it was written up yesterday by a publication. So I would like, for the remainder of my time of speaking, present a new investment. And the new investment is Encompass Healthcare. The Edge actually did write on Encompass, I think about a year ago. We started to analyze the company about a year ago, and we felt that there was a lot of value in the company. Stock was trading in the mid to high 60s at the time. And we did work on the company, and we started to buy some. And then Jana announced that they had a stake in the company. And the company then, the company performed and increased their guidance, and the stock appreciated and went up to the high 80s. And the company did announce, you have here a company that has two businesses. One business, of course, is they own and operate inpatient rehab facilities. The other business is a home health and hospice business. And the multiple that it was trading at was around 9 times, a little bit more than 9. But the home health and hospice business trades at a much higher multiple. And we felt that that business should separate. The company did announce that they were separating. The stock, we didn't buy any more stock when the stock appreciated to the levels that it was. And then in the recent past, it has declined to the low 60s. And we've started to really accumulate in the low 60s and have engaged and have spoken with the company a few times about the business, about the separation, about the execution of the business as a result of the separation. So we think that this is an outstanding business with tremendous growth potential in both businesses, especially in the home and health. And we think that as they split these two businesses and home and health starts trading on its own, that we'll see that appreciation as well as the execution, the operating execution of each of the two businesses that I think we saw in not just L Brands, but you see it frequently in many of the businesses that are multi-segment, multi-company businesses, multi-industry, where they do separate, and there's a much greater focus, much greater intensity in the manner that the business is run, much greater opportunities for acquisitions, consolidation, and eventually being acquired as well. And stocks tend to truly appreciate once you do have that kind of separation. But when you look at Encompass and you look at this page, you see the 2022 estimate. We've included 2022 because obviously 2021 is just about over. So you look at the 2022 consensus numbers, And you look at the multiple and where the company is and where we think it should be. And you look at the multiple and it's about 8.7 times. And we think that this is a business that should trade at much higher multiple. And we think that they'll generate much greater results as the company splits. And you look at the current performance, it's underperformed. It's underperformed the S&P 500. It's underperformed the S&P Healthcare Services Select Industry Index. It's underperformed 1 year, 3 years, and even 5 years. And we've included here just a sum of the parts analysis using the 2022 numbers that we feel our own estimates of 2022. So you look at the inpatient rehab business and you look at a range of 8 to 11. I don't think it will trade at 8, but we always like to look at downside. We always like margin of safety. So if you look at 8 and you look at 13 with the home and healthcare business, which again, as I said, it's highly unlikely that it would trade at 13, but obviously given external and macro and market, if you look at those numbers, even there, it comes to a 64.66 and the current stock price is 63.59, and I think it's a little lower today. So we feel quite comfortable on the downside of this business. And we think that this is more in line to the mid-range, and even the mid-range we feel is on the conservative side, but we feel pretty good that if this trades once it separates at 10 and 16, 17, 18, that this is a high 80s, low 90s business. And you see there a number of 89, 85, which is a 41% appreciation. And it still pays right now a 1.8% dividend. So, which we also find attractive as a result. Generates a lot of cash. And on the high side, which again is not so high, is $105. So we think there's a great deal of appreciation potential in this company. And when you look now at the next page, the demographics of this company, we're getting older, we're living longer, and people want to stay in their homes. For example, from personal experience, my parents, my mom was 89 when she passed and my father was 100. And they were never at a facility. They were not in a hospital. We did have an aide for my mom in the last 6, 7, 8 months. And we had an aide for my father in the last year. And they would have preferred that to anything else. And I think that's the case with everyone, would prefer homes. So there's tremendous amount of demographic tailwind in both of the businesses, because as we do get older, of course, we will have the need for more rehabilitation, for things that break down in head. So I do think that there's tremendous opportunity for growth in the company. The next page shows the inpatient rehab business and the 3 businesses that the company has within that, which is inpatient, skilled nursing facilities, and long-term acute. The next page shows the cost effectiveness of the company. So what you have at encompasses IRF business is higher level of care at a lower price. So it does have competitive price advantages, and that's something that obviously is attractive to when you look at Medicare, for example. So there is a less discharge cost on average. So there is an advantage that we see in this business from others. The next page shows what's been happening in the bed supply in the IRF. So while there's been growth in need, the number of beds that exist has not really grown. So the supply, we feel, needs to increase. So we think that we think that Encompass's IRF business is very well positioned. And then you go to the home health business. And home health, as I mentioned, provides care at a much lower cost than IRF. And certainly is a fragmented business. It's a growing business. And we think that as this business separates and spins out, we think that this will be highly attractive, both, as I've mentioned, in terms of consolidating other businesses and acquiring other businesses, the manner that in which it will be run, which we think it will be run even better than it has been in the recent past, and even eventually the potential for that business to be acquired. So we do think there's lots of potential in this business. The next page shows the Encompass's own growth forecast for the business. And it also includes acquisitions that they intend to make on a yearly basis. So we do think that having our involvement will help. We do think that, having another voice absolutely will help. And we see this as an excellent investment with tremendous growth potential and undervalued at the current price level.
Thank you, Jim. I appreciate that. And that's real insight in there into how an activist thinks. And there's a great idea there. Like Jim says, he presented at the conference 3 years ago on L Brands. And,
exactly.
You know, and then you can see the value creation there. So, you know, Jim, as he explains, works behind the scenes to do that. So very important to spot the right activists. We looked at a study on activists' involvement to see who creates value. That's available. You want to check in with us. But like Jim says, you know, we spotted this a year ago. It's a totally interesting situation, pure value creation here, and one to really have a look at. But Jim, I've got just a couple of minutes for you. We had a few questions come in from the audience. And one of them, I know we looked at a company a while ago, which was the Cheesecake Factory. And, you know, there's all sorts of inefficiencies there. And we strayed away from it because I believe the CEO, I can't actually remember his name, but he owns 40% of it. So one of the questions was, you know, how do you feel about controlled companies and getting involved? Just for the audience who don't know, controlled companies are where a single stakeholder or a group holds a share equal to about 50% or plus. And, you know, for us, it's difficult because, you know, they have such a big voting rights. So, Jim, how do you feel about approaching controlled companies?
Well, let me begin with, if a company's public, if you own 80% or 0.8%, you have an obligation to the other shareholders. And you got to make sure that you're running that business in the best interest of everyone and not just yourself. And the board of directors needs to make sure, and the board of directors can't just be rubber stamp for the individual or the family or whoever it is that controls the company in that manner. And I don't care if it's a dual class stock or an 80%, you know, owner of a particular company. And I think, you know, David mentioned, we're speaking about Berkshire Hathaway. I think that's the way Warren Buffett looks at the company. And I think that everybody needs to take a look at that company. We did some years ago, because this is a question, obviously, that we've always thrown back and forth on these controlled companies. But years ago, we did Dillard's. And Dillard's had an A and a B. They still do. The A voted for 8 directors, and the B was 4, or could have been the other way around. But we did buy a stake in the company. We did add 4 directors on the company, 2 of which are still on the board of the company. The stock is now, I don't know, a couple of days ago, it was $360. It's been a tremendous, tremendous success. And I think that even though the Dillard family controls the company, and I said this actually to Warren Stevens of Stevens and Company in Little Rock, who was on the board of the company back when we had the stake. And I said to him that you're on the board of the company. You're Warren Stevens, and you have an obligation to everyone, to all the shareholders, not just the Dillard family. And you got to make sure that every shareholder that this business is run in the best interest of all of the shareholders. So I think that there is a lot of opportunity there. Obviously, as you know, a lot of these dual class, highly controlled businesses trade at a discount to their intrinsic value, trade at a discount to what they would trade. If a company that has a dual class eliminates the super voting shares, the stock tends to appreciate. And we do think that given, especially today, in the day of governance and ESG, and you look at some of the things like the BlackRock of the world and some of the other much, much larger mutual funds, that some of the things that they're talking about, and obviously the focus on ESG, that there needs to be a focus on that as well. So we strongly believe that it's one share, one vote, and it should never be a dual class. It's one thing if a company goes public, for example, let's call it Facebook or any one of these companies, and you make that argument, even though I don't agree with it, but you could make that argument that it's important to still have Elon Musk at the company because he's the driving force and the creative and obviously the visionary of the company. But for how long of a period of time? So it's one thing if that happens, and it happens in the first 4 or 5 years of a company's trading as a public company. But to me, it should go away at some point. But you have companies, of course, especially like in media, for example, that have been around for so long, and they still have a dual class stock. We do think that that should change.
Fantastic insight, Jim. Just one more question. I'm going to combine a couple of questions in this from the audience. So I guess, when we look at companies, and you might disagree or agree with this, there's 2 things we look at. Is there room for change, and do the shareholders actually want change? Or are they able to be changed? Right? There's 2 things there. So that's what we look at. And I guess a question from the audience was, how do you, how far do you go down into these companies? I mean, and what is the optimum amount of companies you can control? I mean, surely, one company is like keeps your plate full forever. I mean, is it 10 companies? Is it 5? I mean, what's the optimum amount you're active in?
Well, I don't allow anybody at Barrington to do anything else besides work. So we can handle a few companies at a time.
Right, understood.
No, clearly, our portfolio is concentrated. And that, when I say concentrated, it's about 10 companies, and I want to make it even fewer. But the top 5 will represent 60, 70% of the portfolio. And the bottom 5 are things that we might be either selling or starting to buy. So that's how we make up the portfolio. And it's always been that way. And as I mentioned, you really need to understand the business. I remember having a conversation once with a very, very large hedge fund, very large. And they called me because we had a 13D on something. It might have been Dillard's. And, in the conversation, I asked them, how much work have you done? They literally said 3 hours. So I said, what do you mean? How do you buy it for 3 hours? I said, well, that's, we trade a lot. Well, we don't trade. So our batting average, an activist, for example, that is not a trading organization, is holding on to something for 3 years, 4 years, you better be right. So it's not the number of companies that were right or wrong. So it's not like we could bat 500. We got to bat 900. It's about the degree of success of each company, because obviously not every company will achieve the same success, for example, that we achieved at L Brands. So it's the percentage and the degree of success of each company. That requires a lot of work, a lot of understanding. We try to understand as much as possible as we can. Typically, it takes around 3-4 months for us to truly understand the business. And the more you understand the business, the more compelling it makes our argument, which I pointed out before. And that's been the case I've been on 18 boards. And if you call any of those 18 boards, they'll tell you that we have a deep understanding of the business. And in many cases, much more of an understanding than many of the directors that are on the board. But once, what I've found on boards is that once there's someone there with that type of understanding that's willing to challenge, that's willing to speak up in that manner, others start to follow and the board starts to work more effectively.
Fantastic. One more question for you, Jim. Victoria's Secrets, are you still on the board? Are you still an advisor?
I am still an advisor, yes.
Okay.
And we still have the shares.
So here's an out of the box question. So I was sitting in the car with my daughter the other day and I looked down and she's got some Playboy socks on. And I said, you know what? I'm interviewing the CEO in 2 days' time, which was day before yesterday, Ben Cohen. And I said, and she goes, you know what? She's 16. And she said, ask him whether they're going to do they should really do because I was talking about brands at a school and what everyone's wearing, and everyone's got this Playboy stuff at the moment. And I said, people wearing pink. And she said, well, not really. She said, you know what? Playboy should do a collaboration or whatever you call it with Victoria's Secrets. And I said, you know what? I'm going to ask him that. So I asked him that. And he said, I think we're going to grow the brand. And I'm going to ask you the same question because that Playboy getting bigger now in that space. Are you afraid of these emerging companies taking some of that market share?
Well, I don't think so. When you look at Victoria's Secret with 40% of the market share and the dominance that they have, and you look at through the years, 3 years ago when we made the investment, there were all these other online companies that were starting and, all these competitors, and they're at 50 million, 100 million, 150 million. And that was the big concern. And obviously that did not happen. So no, I don't think so. I think that Playboy, for example, recently acquired a lingerie business, Honey Burdette.
Mm-hmm.
And that, it's unique, it's exciting, it's beautiful, but it's small. And so it's a small part of the market. Now, as far as collaborations with others, in this morning's earnings conference call that they had, which was this morning at 8, there was a question about the marketplace, because one thing that Victoria's Secret has started to do is start selling other brands as well on, of course, on their website. And so they now have a marketplace, which is less than 100 million in revenues. And there was a question about that. And he spoke very, very highly and very positively, the chief executive of Victoria's Secret, about that. So that is clearly an opportunity of Victoria's Secret because obviously of digital and so on and so forth.
All right, fantastic, man. Well, listen, I always have pleasure in hearing you speak and your insights. Hope the audience got a lot from that. I know I did. But we're going to halt it there. I'm going to hand you over to Paul McCann, our partner relations person here at the Edge. He's going to give you a little bit of overview of what we're trying to do here. And then we're going to push on with George Muzea and Jonathan Boyar and Joel Greenblatt and John. So we've got a lot to fit in. So we're racing down the line. We're fitting a lot in. Hope you're sucking up all this information and expertise. But Jim, really appreciate you being on today. Thank you. And I'm just going to hand you over to Paul here, and I'll be.
Thanks, Jim.
All right, welcome everyone. We're going to take a little short break. We're about a half hour behind schedule, but I wanted to tell you a little bit about the 3 raffle prizes that we have. Everyone who did donate will be getting a ticket. We have additional tickets. I shared a link in the chat so you can buy additional tickets and see what these are. The first prize we got donated was from the New York Yankees. It's from the 2018 team memorabilia. There's 2 signed products there. There's that baseball and then what they call a yearbook. Where's the next screen here? Where's the next slide? All right, sorry about that. And then the second prize that we'll be giving off is the Pen Club. We'll have 1 night stay for 2 and dinner for 2. And then the last one is Lumina. It's a Mediterranean restaurant right here in Midtown. We have a dinner for 2 for there. So there's 3 ways to get additional tickets. You can buy raffle tickets directly on that link. You can also subscribe to one of our services, the retail product. You get the annual. We'll donate $100 to the Alzheimer's Association, and you will also get 1 additional raffle ticket. If you subscribe to the institutional service for a year, we'll donate $1,000 to the Alzheimer's Association. You'll get 10 raffle tickets. We'll hold the raffle right after the Q&A live. We'll live stream it. So if you get an opportunity, go ahead and click on that link. All donations, 100% are given to the Alzheimer's Association. We'll tell you at the end our tally. We have reached our goal, but we want to go further than that. So if you can dig deep, go ahead, buy a raffle ticket, or if you want, help yourself, get one of our services and get additional raffle tickets there. So we'll take a small little break and we'll be back with George. Thank you.
Okay, welcome back. Had a little break. I hope you're enjoying what's been said to you today. I know I really am. Someone said to me the other day, conference gets better and better. And yeah, of course I'm going to say that, but it really does. The quality of the individuals and what's been said is, you know, still gives me a lot of learning. So, like I say, I hope you're with me on that. We're going to push on here. We've got George Muzea. Now, George, I've known for a long time, and he's been in the business for a lot longer. But what he does is something which seems to be a theme today, really, that is coming out, is looking at management and looking at the quality of management and what they do. Because at the end of the day, you know, it's a people business, and the people are going to determine which way that business is going to go. So what George does is he looks at those what they call insiders. Now, insiders is a funny term when you're in Europe or in the UK, in respect of, you think of insider trading, illicit trading, things like that. But in the States, the term insider is more to mean the company management and what the guy knows, because they are very active participants in buying their own stock and selling their own stock. And George has been looking at the insiders' transactions for a number of years. He's got a great book out there, actually. You should go buy it. It's called The Vital Few versus the Trivial Many, and goes along with a sort of 80-20 principle of looking at insiders and the most important insiders. Now, what George would tell you, and I don't want to steal his thunder, is the fact that you know, there's certain insiders to follow, there's certain patterns to follow. There's certain insiders who just not very good buyers of their own stock. So and they fall into a couple of categories, but he's going to explain that a little bit more. But yeah, if George is in the background there, hopefully he can come on. But I'm not sure if he just popped away. Oh, there's George. So hi George. Thanks for joining us again. I know last time you were super and everyone loved you. We got a tight schedule today. We've got just too much information, I think, to offload onto people. I know your stuff, you know me, every time I meet you, it's just fascinating what you've got to say. And George's analysis and what he does is just, no one else does it really. And like I say, at the Edge, we study George's ideas, and we encompass it into the fundamentals. But really, you know, how he looks at the way insiders behave is really the greatest piece of armory you can have. An insider buying his own stock with a good background of getting it right is kind of a no-brainer sometimes. And we sort of highlight that in our analysis, but I'm not going to speak too much because George is much more interesting. So George, welcome. Great to see you. You're looking fantastic. Why don't you take the stage and give the guys some of your insights.
All right, thanks. Thanks very much, Jim. First of all, I'd just like to say that the presentations by Paul and David and Jim, I really enjoyed those, and I took down copious notes. It just goes to show you how many different types of strategies there are and ways to make money. It's quite a change from the way things were done when I first started in the business. I actually started in the business in 1966 as a stockbroker with E.F. Hutton, another fossil just like me. But in any event, insiders are officers and directors of publicly traded companies, and they have rules that govern their activity. Like if they buy, they can't sell for 6 months in the United States. If they sell, they can't buy back for 6 months. The clue as to which who is an insider is really held by the compliance group of each company. And the key is if they have to file a Form 4. If they don't have to file a Form 4 with the SEC, then they're obviously not an insider. But if they, so I just basically analyze the insider filings I had a TV show for 7 years on called the Muzea Insider Report. That was back in the 70s and 80s. And let me tell you that I was a Lone Ranger. I was the only one doing it. And it was really fantastic. But now everyone's looking at their trading, and people jump on it just because there's buys or sells. That'll change. Eventually they'll get washed out, and we'll go back to, really good analysis of inside activity. I do a little business in Europe as well. And because in Europe there are no rules, there's no SEC. And so insiders can buy and sell the same day. There's no holding requirements. And it's literally impossible for them to, almost impossible for them to be sanctioned if they take advantage of what they know. But so there's advantages there, but in the US, there's also ways of looking at the data that can be helpful. So let me go onto the screen and let's see, where is my, oh, nuts. I think I made a mess of this.
There he is. I think he's just got to bring up the
How
PowerPoint.
do I get my presentation up?
That's all right.
Hit share.
Just, I think you bring up the back and just press share.
Share screen, yeah. I don't see my info here. That's what the problem is.
It's all right. Take your time, George. We're good.
It's not it. Well, I can't find my presentation, Jim, so it's not on here for some stupid reason. So what I'll do is I'll just go back to and talk people through it.
Yeah, talk us through it, and we'll try and find it this end, George, and we'll put it up if we can find it. But I know
Okay.
you're
Yeah, maybe Alex can find it. Okay, but basically my service is I primarily work with hedge funds, and I provide long and short ideas a few times a year, probably about 5 times, as you know. And the basic point of what I do is the monitoring of portfolios. So in your case, you have three portfolios I monitor you for you, and I do that with institutional clients. I have a few retail clients, but they're very conservative people, not looking for an idea a day, and unlimited consultation. Basically, I'm a top-down strategist. I monitor sentiment of most market participants and compare them to what insiders are doing. And I try to do the, oh, there it is. Okay, fine, terrific. All right, we found it. Okay, so I just discussed this, and we can basically move on to the next page. There it is. Okay, I want to basically mention something about the macro picture, and basically this is what I wrote in my recent letter, which is sent out every Sunday to my institutional clients. Basically, as you can read, Fed Chairman Powell has basically been said it was time to taper, but not raise rates. So basically, the Fed has got to put on the market, and it's alive and well. So despite the raging inflation that we're experiencing, the Fed will keep heaving trillions into people's pockets by leviating prices of everything. And you're all aware of that. Non-fungible tokens, you got cryptocurrencies, houses, financial assets, used cars, everything's going up. We had 6 trillion in debt. Now we've got a staggering 29 trillion. So basically the key is bond prices, and until they crater, after investors, are faced a crippling amount of impact of inflation. This is we've got many bubbles, so it's an epic mania going on, and I think it'll continue for some time, and eventually will burst, but nobody knows when. And so my view is that one should participate in the market, keep some average cash reserves, and buy favorite stocks for investing or trading. And so then I would like to go to the next page if I could. I'll need your help to push this up. Oh, there it is. I've made a lot of mistakes over the past 50 years and in monitoring insider trading, but some of them were made very early on. And I wrote down the PhD rules because I'm going to give you what, the long history of my work summed in just a paragraph or two, because insiders basically are value investors. They buy into price weakness and sell into price strength. So at market bottoms, there's a lot of insider buying because most insiders are value conscious and they're looking at book value. So at the market bottoms, there will be enormous numbers of insider buying. And at the same time, you'll have very negative media, and the hedge funds will be extremely bearish. It just works that way on every bottom. So my work is exceptionally good on bottoms, not so good at tops, because of the momentum, and things last a lot. Strength lasts a lot longer. Bottoms are easy to see because the contrarian behavior of people just is the same at every bottom. So we buy. So insiders buy into weakness, and what I've learned over the years is we should not buy into weakness. We buy when they pay up a stock. And back in 73, 74, that was a bear market that is probably the worst bear market. Well, certainly the most incredible bear market I've ever seen. It lasted 2 years, 73, 74. And the reason why I don't buy into weakness is because of my experience in 74, when the market started, the market created a total of 60% in those 2 years. But it was drip, drip, drip like a mudslide. And every day I would come in, the market would open higher, and it would close an eighth or a quarter lower on each stock. It just was really amazing. As a stockbroker at that time, I remember running out on the day after I got a new account and to get a deposit. And if they didn't give me the deposit, I didn't take their account, because I knew by a settlement date the stock would be lower. It went on for a number of years. There were 20 at the bottom in 74. There were 20 companies that I found where you could buy the stock. Let's say it was trading at 12. You could buy it for 12, and liquidate the company, liquidate its current picture, the current assets, pay off all its debt, and get your $12 back, and own the plant and equipment for free. I had 20 companies that had those characteristics, and made a hell of a lot of money for myself and a lot of other people. But in the 2003 bear market, 2008, the most recent one, I didn't find any of those stocks. So certainly 73, 74 was a brutal bear market. And I remember in January of 1974, I remember buying because insiders started buying all the way down. Well, a lot of my clients weren't there at the bottom because they'd given up. And that's when I learned that you don't follow insiders into price weakness. You wait until the stocks turn, and then there's already got some sponsorship by Wall Street. And once the stock turns, the sponsorship is evident. And then when good news hits, insiders pay up, and then subsequently afterwards, there'll be good news that'll come out. And by that time, it's already got sponsorship and the stocks really take off. So PH rule number one is insiders buy into weakness. Mistakes I did back in that bear market of 74. So we buy when they pay up for stock. So in insider selling, the insiders will always sell into price strength because they're getting more options, and they'll just keep selling. If they're selling less than 10%, it's actually a bullish event. So we don't short when stocks have lots of insider sales. A lot of the institutions do, but it's the wrong thing to do. We short when they sell into price weakness. The best example of that is Enron, and made a lot of money for people in Enron institutions, where Enron was selling into price strength on the way up, and we got to 90. And then when it got back down to 60, the same people who were selling on the way up were selling on the way down, especially the CFO. And I put out a short on that one. And as you know, the story on that one, stock went to zero. So you sell, you'll never catch the top. Most institutions want to sell the top, but it can't be done. I made that mistake in the 80s when I had a date and went on a cruise ship, and I shorted a momentum stock because there was heavy insider selling in it like a fool. And I couldn't reach my broker because we didn't have cell phones then, and the ship's radio wasn't working. And when I got back, the girl I was with was pretty disgusted with me because I was not very attentive. But when I got back, I took a big hit, and I started to realize there had to be a better way to short using insider trading. And so basically what I'm telling you is you're benefiting from my many years of making mistakes, but I haven't made many lately because I made all the key ones. So we buy when they pay up a stock, and we short when they sell into weakness. That's all you really need to know. Now, if you have the ability to analyze their track record, that's a big plus, which is what I do. And there are certain insiders that are more valuable than others. I would say the most valuable insider is people in the financial department, chief accounting officer, chief financial officer, divisional officers. The least reliable to follow are outside directors, the CEO, who has a lot of scrutiny, and of course the chairman, and guys like Bill Gates and Elon Musk. You know, their trades mean nothing. But it's because they'll be scrutinized because of the size of the trades. But the people that fall through the cracks with the SEC are going to be the chief accounting officer, chief financial officer, and these divisional officers. So let's see. I think I have a couple of ideas. Can you change to the next page for me, Jim? There we go. There's a couple of ideas for you. Just to give you an idea of the type of analysis I do. This is Kevin Wilson. He's with a company called Heska, HSKA. As you can see, let me move this to the side. Okay. As you can see here, he bought in February 2013, 260,657 shares at 826, and you can see that you know, here these sales were made at 110. So the guy was pretty right. Now on this particular trade here, there's 1,000 shares of 179. Holdings hardly moved because he's got a lot of stock, but that wasn't by him. That was his wife. Now my wife is Sicilian and she's got a temper, and I've learned to sleep with one eye open. And she's, you know, so I don't think I would ever make a mistake on giving her a recommendation. And I don't know about this guy, Kevin Wilson, but the fact that his wife bought 179,000 shares, 1,000 shares at 179 into the recent price weakness in the stock, in my opinion, is a good thing. So that analysis is how I come up with this stock. It's a little unusual, but you know, that's just the way it works. I'm looking for unusual behavior, and certainly this company, this particular insider doesn't need the money, and his wife doesn't need the money. They bought it $8, and so the fact that she bought 1,000 shares into this weakness, and he, you know, he probably got the information on what things are going on there, how things are going from him. So, and he doesn't want to lose it. So that's that. Let's do the next page, the next stock. Okay, this is Richard Lindahl. He has an MBA from Darden School of Business at the University of Virginia, BA in Computer Sciences. So he's pretty solid. And he bought this company, Emergent Bio Solutions. But if you look back here, you'll see he bought Nextel at 17, and then was able to sell it at 26. That was back in 03. And then we've got him in this company, CEB, buying it at 41 in November 2012, and selling it at 61 in 2014, 2 years later. So he's either very lucky or very smart. And he just bought another. He just bought 3,000 at 37.46. As you can see, the stock has been hit pretty hard. I don't know what these companies do. That's not my job. My job is to analyze insider behavior for people and let them know what I think. But so these are two recommendations and two ideas. And what I'm looking for are people who have done things well in the past, or something unusual like this wife of this other Kevin Morris buying that other stock. So that's pretty much one of the things I wanted to get across. And if you've got some questions, I can probably answer them. So let's see. I'll go back to. Okay. I don't know. Can you see me, Jim?
Yeah, I see you, George.
Okay,
Thank you
good.
for that.
I just want to make someone asked me, a money manager, hedge fund manager asked me recently what I thought of the market from a top-down perspective, and I already explained that. But he was asking me about if there's any comparative notions regarding which other cycle, the current cycle is comparative to. And I told him about 73, 74. In 73, 74, we had a Middle East war. I think Syria and Egypt attacked Israel. But oil prices had quadrupled. Inflation hit 12%. We had a resignation. But, you know, we've got inflation now, and we've got unprecedented, epic money creation. So I don't know if they're completely similar, but no two bear markets are alike. But one of the things I wanted to just mention was that in 73, 74, there was every stock went down. I mean, it was a brutal stock market, one of the worst in history. And the average stock went down 60%, and some much more. But one vehicle that quadrupled was gold. Now, I know gold is not very fashionable right now because of cryptos, but I think one should be aware of you know, the fact that in that particular bear market, gold was a good place to be, and so that's something that one should think about.
George, I'm going to jump in on you, cut you a little bit short. I hope you can stay around. I've got a few Q&As for you.
Okay,
if you can stick around, that'd be great, because I want to fit Jonathan in and then Joel. and Jonathan's been waiting patiently there. But I do appreciate what you said today, real insights. I mean, don't underestimate the casual nature of George, the way he speaks, because his stuff is real gold. That's the gold. The way what comes out of George's mouth. So we're going to have all these presentations for everyone afterwards, so don't worry about that. I just want to make sure we all our speakers get some good good exposure. Now I want to introduce, so thank you for that, George. I really appreciate it. I'm always happy to listen to you. So let me bring Jonathan in. Jonathan Boyar. He's you know, if you want pure value, he's your man. And Jonathan and I have been talking behind the scenes a lot, and we have a similar views on a lot of that. But I want to hand over to Jonathan. He can tell you what he does and how he does it. But he's got some great ideas, I know, and I'm keen to listen to him. And I'm sure he's got some more gold for us. So Jonathan, let me hand over to you. And I appreciate you waiting that long as well. I know it's been a while. Thank you.
Oh, no, it's been my pleasure. I just want to first make sure before I go that you can see the slide.
Yes.
Okay, so you can see the logo or whatever. Great. Just wanted to make sure everything's technically correct. So
perfect.
First, thank you for inviting me. You know, I really appreciate it. And also I want to thank my team, because without them, this presentation would certainly not have happened. So here we go. Here's for the lawyers. Just put it there. We own. I own every stock that that I'll present today, and I don't think you'd want me to do a presentation where I didn't. So first, let me just briefly explain what the Boyar Value Group is. We have two separate but distinct businesses. We have a research service, which was started by my father in 1975 to provide independent research utilizing what we like to call a businessman's approach to stock market investing. And in 1983, we formed Boyar Asset Management to utilize those ideas to manage money for both institutions and individuals. So today I'm really just going to do two things. One, just briefly discuss how we come up with investment ideas, and then present three ideas from really three different schools of thought for value investing. You know, value investing has a wide tent, so there's many different ways of being a practitioner of it. The first company I'm going to present is an example of a great consumer franchise that is selling at a discounted price. The second is a statistically cheap stock, more in the traditional value camp. And the third is an example of a non-traditional value investment, where it's far from statistically cheap, but has other attributes that we find to be attractive. So I think we have a pretty unique investment approach, you know, taking that private equity approach to public markets. The thing that separates us from most is being patient. We're extraordinarily patient, and we're not afraid, or, you know, we're willing to hold companies for 2, 3, 4 years. Some companies we've held for 10, 15 years. So we're long-term, and we take taxes into consideration. You know, deep research is really at the heart of what we do. We analyze every company in the same way as an acquirer would. And, you know, we don't look at takeout candidates per se, but because of the way we look at companies, many of the companies that we profile or buy for clients end up being taken over. So the sell decision really is made on our behalf a lot of the time. Things we stick to our knitting, but things we avoid are, you know, commodity-oriented businesses, cyclical businesses for the most part. But besides that, we're both market cap and sector agnostic. We go from microcap to Microsoft. So we're, you know, as long as it's cheap and we can understand it, that's something we'll look at and potentially buy. So people ask me, how do we, you know, come up with ideas? And, you know, there's no screens, no algorithms. That's proprietary. It's really just being curious and reading a lot. However, through the years, we've systematized our approach and, have a few different buckets on how we come up with ideas. The business value approach, we like looking at entire industries that are out of favor and pick the businesses within those industries that we think are the survivors. We love looking at at hidden assets. One, because they can't be screened. One of the names that, I know Jim is into as well as we are is Madison Square Garden Entertainment. And it has, very valuable air rights that are reflected on that are not reflected on the balance sheet. So no screen in the world would come up with them. And, we love special situations as well. But while we're patient, we also look for catalysts. One of the things that my father, Mark, has instilled in me and instilled in our team is that you can find the greatest company in the world selling at a cheap price, but if it doesn't go up in value, it doesn't do you any good. So to us, looking for catalysts helps us avoid value traps. They're critically important. To us, value isn't its own catalyst. So what's our edge? I really think it's twofold. We invest in a lot of companies that are kind of outside the mainstream of Wall Street. That allows us to leverage our analytical capabilities. And having a long-term time horizon is something that is critically important too. Playing the short-term game, at least in my opinion, is much, much harder. And the other advantage is, since 1975, we've been publishing independent research on a subscription basis. And, to us, having to put pen to paper and having to continuously come up with ideas for a very sophisticated audience and getting critical feedback really helps us, really hones our idea generation capabilities. So I'm just going to very briefly go through 3 companies. I know I don't have a lot of time. I know we're running a little bit late on this, but the first company is a company called Scott's Miracle-Gro, ticker SMG. It's an example of a great consumer franchise selling at a significant discount to our estimate of intrinsic value. And there's been a lot of talk about inflation. To us, great consumer franchises are terrific investments at all time periods, but especially during inflationary environments as they have pricing power. So here's a little bit of financials, the company, and kind of how the company is broken up. It's 2 businesses. They have the traditional consumer business that really has Coca-Cola-like market share, has been a tremendous pandemic beneficiary. And they have a second division that's not as well known, potentially, called Hawthorne, which is a hydroponics business that primarily serves the cannabis industry. And this has quickly grown into a major business for them and is a real growth driver. So, what's the competitive advantage? As I discussed, the brand recognition is really important. And just as one example, one of their competitors is a company called Central Garden Pet. A few years ago, we saw in one of their filings the following quote: "Our turf and forage grass seed products, fertilizers, pesticides, and combination products compete principally against products marketed by the Scott's Miracle-Gro Company. Scott's dominant position in the lawn and garden industry is a significant competitive disadvantage for our similar garden products. They're by far and away the best brand in the industry." The millennials moving away from the city into the suburbs has been a big boom for them. Sales during the pandemic increased greatly. And with cannabis being legalized across the country on a state-by-state basis, that has really helped the Hawthorne business. And just briefly, the Hawthorne business does not grow cannabis. It's more of a pick and shovel during the gold miner rush type of situation where they provide filtration and other types of lighting, etc., for cannabis growers. As you can see, in fiscal year 2020, they had a 24% increase in sales. 20 million new customers entered the marketplace, and the surveys that Scott's has done has showed that many of these companies will continue to garden. Shares have been under pressure for a variety of reasons. Interest, it peaked at, I think, about $254 a share, went down to about $139. It's presently about $170. And one of the reasons for the weakness, we think, are, cannabis shares have not had a good run since April. So there's been some sympathy selling there. They're under gross margin pressure. And that's only because they're investing in the business because of the tremendous growth they're experiencing. And they were up against difficult comps. Something that's critically important to us is having a CEO with skin in the game. And if him and his family own 26%, that certainly qualifies, in my opinion. They're great capital allocators, and they utilize their strong cash flow to delever significantly. And they're very shareholder friendly in both their buybacks and special dividends. They buy back stock when it's cheap, and they issue special dividends when they think the stock is expensive. In a recent Barron's article, the CEO, one of the executives of the company hinted that they're going to be very aggressive on the buyback front. So what's the catalyst? What's going to make the stock ascend in value? There are a few different things. Spin out of Hawthorne, they've hinted at. I think that could happen in the next year or two. It's just not being properly valued. Continued share buybacks and cannabis reform / legalization should help tremendously. So here's our valuation, how we get there. And at these levels, basically the way I look at it is you're paying a full price, private market value for the consumer business, and essentially buying the fast growing cannabis business that's profitable, that's growing rapidly at one-time sales. So it's at these levels, I think, unbelievably attractive from a longer term perspective. The next company is Curate Retail, and this is in the bucket of more of a traditional low PE value investment. And it sells at a low PE because of concerns over the long-term viability of the business, which we think are misguided, and it's controlled by media mogul John Malone. What is Curate? It's a combination of both QVC and Home Shopping Network, which I'll discuss in a bit. It also owns Zulily, which is another online shopping company, and Cornerstone Group that has brands that you would recognize, such as Cornerstone, and it's a really misunderstood business. Great operating margins, stable cash flow. In our estimation, it's selling at about a 26% free cash flow yield. And the company's misunderstood. They really think they don't understand how good the demographics are. They have really attractive demographics. The people who go on the website spend a lot of money, especially the fanatics, and they have huge retention rates. So it's something that Wall Street, for some reason, doesn't get. But if you look at the numbers, they're certainly there. So Curate was a fantastic pandemic beneficiary, especially coming out of a difficult 2019. But they positioned themselves really nicely in that they're available everywhere, essentially. They're on almost all the streaming platforms, linear TV, websites, etc. They make it very easy for you to shop. The most recent quarterly results were somewhat disappointing, but we're chalking that up to supply chain issues. We think the long-term viability of the business is pretty strong. Selling at an extremely attractive valuation, and you have a master capital allocator in running the show or behind the scenes with John Malone. They paid a lot in special dividends. They just issued another one for I think $1.50 a share. They issued 2 last year. They've also issued a preferred. So they've really returned capital to shareholders. They're buying back stock. And we wouldn't be surprised because of the valuation, so how cheap it is, if it either went private or was acquired by a competitor. It's worth noting they're having their investor day tomorrow, and this is our valuation and how we get there. The last company is probably a surprise for anyone who thinks we're just pure value investors. We consider ourselves opportunists. And like when we profiled and bought PayPal about 5 or 6 years ago, we see a lot of value in the network of Uber. Just to let you know, both Uber and Scott's Miracle-Gro, there'll be a link at the end of the slide where you can see our reports on them. So Uber has 2 main businesses, which I'm sure most of you are very familiar with. They have a mobility business, which is their rides business. And they also have a delivery business that was a big pandemic beneficiary. And this is how its gross bookings are broken up. And we think mobility, because of the pandemic, is running well below capacity and will be a great reopening play once we get back to some sort of normal. It's also a misunderstood opportunity. This is not the Uber that was a unicorn that was spending money like drunken sailors. It's a much more disciplined company led by an experienced operator. They've done the right things. They've exited most businesses that they don't have a path to be number 1 or number 2 in exchange for equity stakes. So they're able to participate in future upside. But their improvement in the business really has been obscured by the pandemic because the rides business was so profitable and was really on the way to great profitability, but that has obviously declined due to a decline in ridership. Pre-pandemic, mobility was tracking at about 30% adjusted EBITDA margins. Even after a 75% drop in bookings during 2020, they were still pretty profitable. They've decreased corporate overhead significantly, and we think EBITDA could scale really quickly. And as I've written here, probably the most underappreciated aspect of the business is the cross-platform synergies, and that's something that we're very excited for. Like most businesses, they've been plagued by labor shortages, but they've spent money to solve the problem, and it's gotten significantly better. The number of drivers is up 65% since January. Wait times are down. So they're doing all the right things. And even when they had surge pricing during the summer, it was, consumers still used it. They may have grumbled about the pricing, but it shows, the convenience and the value add of the service. And, it's trading, if you look at some of the comparables, it's trading pretty reasonably. And it's something that I think is really just overlooked and misunderstood. And, here is, our valuation, as I said, for both Uber and Scott's Miracle-Gro. There'll be a link, and I believe the organizers will also send you the link to download our reports. I'm happy to open it up for any questions that you might have. And again, I want to thank Jim and his team for inviting me to speak.
Fantastic. Thanks, Jonathan. Yeah, like I say, it's very interesting. Someone raised a point there, and we spotted it the other day as well. And Uber, you had the CEO buying actually as an insider buy, something very topical George was talking about. And in reality, in its historical significance, that the CEO of Uber has been right with these buyers before. A lot of, there's a lot of, So the trouble with CEOs buying, and I don't know if George got anything to say on this. The trouble with CEOs buying is that, you know, they got to kind of make a mark really with their stock. They got to buy their stock, right? They got to be seen buying their stock. They get paid an enormous amount of money usually, and they got to be seen buying their stock. I think, you know, so that's why you got to identify some of these at the CEO level, which, you know, isn't the most strongest level, but it's, you know, like I say, his history has been right in that buying Uber. And I agree with you on the stock, and we're going to overlap on all your stocks. You know, it's an interesting one to look at, the potential as well. So, you know, you got a couple of things going. You got Jonathan's overview of that fundamental, but he also got insider buyers. So yeah, super interesting. But thank you for that. And I don't know if is there any, we got any questions for Jonathan here while he's here? Oh, here we go. So we got one. It's got one from Mark. Mark says on MSGE, what does Jonathan think the stock is worth? The Delta wave in NYC this coming winter is likely to present one big opportunity. Tell us a little bit about your view on MSGE, John.
Yeah, MSGE, I know, is a name that you follow as well. I think it's unbelievably cheap. I mean, we have a valuation anywhere between 100. I know this is a very big range. Our bear case scenario is $124 a share. Our bull case is 210. Stock selling for 70. Obviously, you're dealing with the Dolans there, and I think they're much better operators than people think. It's a fantastic reopening play, and I don't think people realize the significance of online sports gambling and how that has helped their business in terms of advertising, sponsorships. There's so many things that could be done to unlock value, and I think Dolan's a better operator than he gives him credit for. And I think at some point in time, he could take it private. MSGS is also extremely interesting. That's one I think he's more likely to sell.
Okay, great. Thank you. I've got a couple of more questions, just a couple of last ones for you. Got one from Keith. He says, Curate Investor Day, what do you expect them to say or do? Is there any read through on IMBI's results?
Yeah, it'll be interesting. I don't know. I mean, Liberty's having their day today, and tomorrow's Curate's. Who knows what they're going to say tomorrow? You have a new CEO kind of, at the helm now. So, I mean, you couldn't reset expectations any lower really at this point. So I just think you have a stock that everyone's just given up on, but I emphasize how shareholder friendly they've been, with all the special dividends that they've done, the buying back shares. I mean, pretty soon there's gonna be no shares to buy back.
Okay. And one last question again on Curate. Someone's asking, they've got two classes of stock, one at 8, one at 100. What's the deal there?
They might be thinking of QRTEP, which is the preferred.
Okay.
Is the one beside the one that we own is QRTEA, which is the A shares. But they issued this, and it's a kind of a funny thing. About a year or so ago, they issued this preferred QRTEP that goes to about 2031, yielding about 8 or 9%. And this is really shows how the efficient market theory is a bunch of nonsense. They spun it out. There was such forced selling that this thing that we believe is most likely money good went down to about to $88. It's now trading at 107, 108. And Malone owns it personally. So it's another example of them being unbelievably shareholder friendly.
Okay, fantastic. Well, listen, we're going to wrap it up there. I really appreciate. I don't know if you're going to stick around a bit for a Q&A. You got some time in 15 maybe, or do you have to jump?
If it's in 15 minutes, I'd be delighted to join.
All right, man. Well, listen, let's keep putting your questions through on the Q&A. And our next guest, I know, really needs no introduction. Joel Greenblatt really is the pioneer of spin-offs, and really, if anyone's read Who Wants to Be a Stock Market Genius, I think that's, well, I'm not sure that he's most famous for, but one of his more famous books. and also the little book that beats the market and things like that. It's a real pleasure to have him here and really talk about spins, and I'm delighted actually he's here. And I just want to introduce him. He can introduce himself, but he does a lot these days. And like I say, really excited. We've had a great presentation so far, Joel. I know the guys are looking forward to it. I had lots of emails about you and your speak. But what can I say? How can I introduce you? I'm going to hand it over to you. Why don't you take it away?
All right, thanks so much. Nice to be here. I'm going to leave a lot of time for questions. Just give you a brief introduction to how I got involved in spinoffs and special situations. And I really told the story, and You Can Be a Stock Market Genius, one of the worst titles of all time. And at the opening of the book, I described special situation investing like this. My in-laws used to own a place, a weekend place in Connecticut, and they'd spend their weekends going to country auctions and yard sales and estate sales and antique shops. And what they were looking for is when they found a painting, the question they asked was not, is this painter going to be the next Picasso? The question they asked was much easier. They said, hey, has there been a painting recently sold at auction by the same artist, same genre, for 2 or 3 times what I can buy it for here? And there's a totally different questions. One skill, is this going to be the next Picasso? You need skills that almost no one has, really, and very hard to acquire, and also very hard to be right and very uncertain. The other skill, which is finding something off the beaten path that, and that's why you're getting paid, because there are things that you can compare it to that sell for much, much more, as you say, leave a large margin of safety. That's just a much easier question. And I'm kind of lazy, and I thought, that's something I could do. And I think as a special situation investor, I think that's really what attracted me to it. I didn't have to be, in investing, it's hard to be right, and there's a lot of people competing with you. And so as Warren Buffett would say, hey, look for the 1-foot hurdles. And for me, special situation gave me many more, special situation investing gave me many more 1-foot hurdles to look for. And in particular, one of the longest parts of the book was about spinoffs, and that was just such an obvious thing. And I think this year we have more spinoffs so far this year than any time. I was reading an article since 2011, and that's just year to date. So hopefully we'll finish with even more spinoff announcements. So still very pregnant area to look at. And, I think big picture on spinoffs, a lot of people take a look at the academic research, and what they'll tend to do is say, well, if you bought all the spinoffs, did you outperform the market or didn't you? And I just think that's the wrong question. I think the right question is, are spinoffs a pregnant place to look for opportunity? Mispriced securities, they could be overpriced, they could be underpriced, but because of the nature of the fact that people haven't seen this before, they're not sold, the incentives are different. We'll go through a few of those. It's opportunity ripe for mispricing. So it doesn't matter how the average spinoff does. This is an area that's ripe for mispricing. Could be overpriced, could be underpriced. How the average does is completely irrelevant. This is just a really ripe area to look for opportunity. And that really was the point. I think people missed the point saying, oh, I want to do something mathematical and just buy all the spinoffs. I think, a lot of studies saying that has worked, but that's not really the way I look at it. I just look at it as an opportunity-rich zone to look. And if you think about how spinoffs are created, usually companies are getting rid of businesses unrelated to their main business, or there's a business that's considered bad and they want to separate it from the good business, or it's just something they bought, it was a mistake, they can't sell, so it's unwanted. Or maybe the business they have is a low tax basis, and this is the most tax efficient way to get value to shareholders. They could be solving some strategic issues or antitrust issues or regulatory issues. And there's a number of reasons why spinoffs tend to do well. And that's what goes both for the parent, the remaining parent, and the spinoff itself. And that's because that's the motivation. Usually a lot of motivations to buy businesses when, managements really like to increase their domain and their influence. When they're separating things, they're losing influence. They're losing assets under their domain, and that's not a natural thing. And so really the only incentive would be to maximize shareholder value. There really isn't other. It doesn't always happen, but their bread is buttered with the shareholder in this case, where they're trying to create value through this transaction. And that's not always the case. Certainly with mergers, it's not the case, but with spinoffs, the opposite of a merger, it actually is. And you can do well because it's small relative to the parent. You could do well because capitalism actually works. When you separate the businesses out, then management can be incented directly with how they perform in their business. Usually they can do well because the people receiving the spinoff didn't actually buy the business, buy the stock for that reason. And so there's excess supply, people who didn't want it in the first place. There's usually, because it's not usually goes together with an IPO, there's not a lot of research available on that individual company, either because it's too small or because it's not in the area that an analyst would naturally follow. They're mostly following the parent. So it's underfollowed initially, and it's a new business that's not being IPO'd. So there's usually not a big roadshow. In fact, there's impediments to saying too much before the spin-off. And I'll name 3 other things that you want to look for. Maybe we'll talk about a recent one, then go to questions. What I wrote in You Can Be a Stock Market Genius is one thing is to look for is that institutions don't want the spinoff. And that's either because it's too small, or it's in an unpopular business, or it's too complicated, or a lot of reasons. But all you want to look for is, hey, will institutions who receive this distribution really want it? And so that's one question you might ask. Next question, and probably the most important thing, is what are the insiders doing? Do the insiders want it? Are they taking options? Are they trying to get rid of it and keeping their options in the parent? Which management groups are going to which part, the parent or the spinoff? So those are things to look at. What are the insiders doing? And then often a spinoff is just being done because there's a new business or there's an old business and the value is being masked. Either the value of the parents being masked or the value of the spinoffs being masked. So these are things that probably most people who signed up for today know about, but I keep reading Warren Buffett because I learn something new every time, or even if I didn't learn anything new, it reminds me of what I should have thought. So, I haven't done the work yet on GE, but, obviously GE's announcement earlier this month, and it's splitting into 3 pieces, which is always fun. It's really complicated because there's a lot of complicated liabilities, and even in a couple of years when this spinoff takes place, so we'll have plenty of time on this. This isn't something like high frequency trading. That's what I like about spinoffs. You have time to look. But something strategic is going on. It's being split into 3 pieces. I think when it came out, stock was at 107. It went to 115. Now it's below 100. Last I looked. A lot of disagreement. If you look at analysts, there's some analysts with a $150 target. There's one with a $55 target. So that's kind of fun. A lot of disagreements. Why this one looks interesting. There's a lot of liabilities here. They're going to be worked down to maybe 35 billion, but it's roughly $100 billion market cap and 35 billion in debt. Where does it go? It's fairly significant, and a lot of these liabilities have been hidden for a lot of years. So which pieces are they going to be going to? There's a lot to be looked at. Where do the management options go? In other words, now that you have 3 separate pieces, which management is getting options on which pieces? There's a new way to incent people. And one of the things that's really fun on spinoffs is, besides that, usually there are limits on what the management from the individual divisions can say before the spinoff. Their incentives, if you want to look at their incentives, are most likely to say nothing good. The reason they don't want to say anything good is because their options are probably going to be set after the spinoff, and they'd rather trade lower than higher. And so that's fun here. So I wouldn't expect to hear too much good information come out of here, or even if it's not good information, clarity, better not to be clear. It's a famous line in economics, one of my favorite economics books, and it starts with, if you have to learn one sentence about economics, it's people respond to incentives. And it's especially clear here when you're talking about spinoffs, where it couldn't be more blatant. And so the incentives are to keep the stock price low. That's where your options are going to be set. Not necessarily for, current key management at GE, probably get pieces of each, not really clear what they're going to be getting. But for the management of the divisions, it's going to be really interesting to see where that goes, where the debt goes, where does management go, which divisions, what do they keep a stake in, what do they keep their options in? And so without having analyzed the 3 businesses, healthcare, energy, and aviation, and each one is complicated in its own right, which is actually not bad, it's really great. And as you see, the analysts are between 55 and 150, and the liabilities are questionable, where they go and how much will they really be. And each business is fairly dynamic. And, one of the reasons for the spinoff clearly is that, let's say you have a healthcare spinoff and that's moving, you want to make acquisitions in that area. It's better to have a very specific stock in that area to make acquisitions with, and a place to, and you either got to buy or build. And I think in a lot of these techie areas, these various divisions are going to be doing both, and they're going to need the flexibility to buy or build. So this really, just in one name, kind of a disaster for the last 20 years. As a stock, and and just the nature of the people who own GE, and how complicated I just made it sound, which it is complicated. People are just going to throw up their hands and sell the stock, which I think is some of what's going on here. They just don't want to be there for the separation because they won't know what to do with the stocks then, and this is just simpler. So for all those reasons, kind of fun to see how this plays out over the next couple of years. And like I told you, I'm a little lazy, so having a couple of years to work is good. Anyway, I'm going to leave it there. But GE is just a great way to look at all the different things you're looking at. And we didn't even look at the fundamentals yet. We're just looking at the dynamics of the spinoff transaction and seeing all the complications, but really the simplicity of what you're really supposed to be looking for. And just leave you with one thought. It's not, and I wrote this up in the book, not really fun to dig holes in the ground, run around the neighborhood digging ditches. It sounds like a pretty boring job. But if I told you there was a big X someplace, and if you go look there and you start digging there, you have a good shot of finding some treasure, some buried treasure, that gets more interesting. And then when you find the X and start digging, that's probably even more fun than just digging up the neighborhood randomly. And so spinoffs really are the big X. And, in this case, GE has 3 big X's for you to look at and see if there's some opportunity there. And really focuses your energy in specific areas that are pregnant for mispricing. And this particularly, its complication is in this case a good thing for analysts. And so I think this one should be fun and
Thank you,
worth
Joe.
looking at. Didn't even talk about fundamentals.
Fantastic, man. That's great. And thank you for your insights. And we've got a couple of questions coming, which I'll answer in a minute. But just to echo everything Joe said, I mean, there's loads of spin-offs going through. I think there's more. I mean, a lot of these things happen. You know, I'm not calling the top of the market, but a lot of them happen at the top of the market and they happen at the bottom of the market. And they're, you know, the ones at the bottom of the market actually are more interesting than me because they're usually distressed spins. So, you know, that's something that we look at very closely. And I think he's echoed a lot on looking at the management and the incentives as well. We've got a question about that in a second. But one of the things that, you know, I've noticed, Joe, in recent years, and your book was inspirational right at the beginning for us when you said, you know, look at the fundamentals, look at the technicals, and look at the insiders, right? That sums up everything you said there. And we still, you know, adopt that today. But I think that, you know, one of the things that has changed for me over spin-offs, I've been doing this a long time now, is the fact that, you know, some of these companies spin, but no one really cares about the spin, even though it's getting cheap. There's a couple of them out there right now that are just cheap that I'm still not buying because they're still falling. And yeah, there comes a point where, you know, when do you buy them? And I think that that's a real issue because, like you say, people are more concentrating on the high growth names. They're looking at that. And these spin-offs can be so undercovered that they can get really cheap. And it sounds a little bit silly because you say, well, go and buy them. But, you know, they get even cheaper. So, you know, unless you've got deep pockets, you know, you're going to have to wait. But one of the questions was, you know, what do you think there's any negatives in looking at this space? I mean, is there something you would kind of say, you know what, you should watch out for this? Is there anything you can add to that?
Once again, I mean, my number one rule is that if management is not incented with me strongly, and by that I mean not whether they have a big investment relative to mine, but whether they have a big investment for them. In other words, and the first thing I look at is how much are they making in salary and bonus, and how much are they making for every point the stock goes up. And if there's a huge dichotomy there, and I like the business and I think management's going to try to do the right things, and, you know, I have any read on that. And of course, you know, you probably should punt on most of them. So when all those stars align, that, you know, the management looks good, they're incented correctly, they're going to make most of their money if the stock does well. If I'm putting an X within the X, that's really where I spend my, you know, for the buried treasure, that's really where I spend my time. And that's the only things I really want to waste my time researching to decide whether the setup, I need that setup. And once I have that setup, a lot of things are in, even if I'm a lousy analyst, a lot of things will be in my favor. And so that's really what I would look at first. And there's a lot of times where management is just not incented well. And regardless of what I think, I rarely would pull the trigger on something like that.
Okay, great. So we had a lot of questions on, and you know, I kind of know what we do, but a lot of questions coming in on incentives and stock options. Now, I think if I remember correctly, in your book, you said it only matters if the guy puts, or girl puts his hand in his pocket to buy the stock, right? We've had George Muzea here talking about buying stocks into strength and selling the weakness. Do you really care for stock options? I mean, look, if I join a company, I'm CEO, and they gave me a load of stock options, yeah, great. I want the stock to go up. Do I really care that, you know, am I fighting my life off to get to those stock options? I mean, what's your view on incentives in that sort of respect? Obviously, someone puts their hand in the pocket. We've seen Uber presented today. The CEO's put his hand in his pocket again. He's been right 2-3 times before, right? I get it. But, you know, what do you see as the most important in that aspect in terms of incentives, really, or you'll say, or the stuff that you don't really care for?
Right. So I didn't say anything in the book about putting your hand in your pocket. I mean, that's something you can add if you like. For me, it doesn't mean as much. I'm more, if you're making $400,000 a year, but $1 million a point on the stock, I'm guessing you want the stock up. And it's not more complicated than that. usually when you're talking about the options, the management options you're talking about, it's kind of a part of compensation. It's a reasonable amount relative to their salary, and it's not 10 times the amount or some number like that. It's a percentage of what they're making each year. And you're right, that's probably nice to have, but I won't put that much weight on that. But if it's a huge dichotomy between the value of, you know, if the stock went up 50%, how much would they make relative to how much they'd earn, you know, from their salary and bonus? And there's a huge dichotomy there. That's what I'm looking for. So I wouldn't say, yeah, normal amount of options they hire you, and you give options that are a percentage of your salary or part of your salary and bonus. Yes, that doesn't mean as much to me. Reaching into the pocket, it's nice to see. Of course, that's a nice to have, but a lot of these people want to make their fortune and they're hungrier. And so if they're really getting paid 10 to 1 on stock appreciation, that's what I like to see.
Because we recognize some of these, and some of the stuff we do with George is that, you know, some CEOs or some management are not really good at buying their own stock. And, you know, that could be a problem if you follow them as well. So I back up what you say. I think it's sort of sometimes important, the pattern of the buying and their history. That's very important to us in terms of when they put their hand in their pocket, I think. But not so much stock options. Again, we're with you on that.
Well, just say necessary but not sufficient. So in other words, you actually have to do work.
Yes.
I'm sort of trying to tell you to do the work in the right place is
yes. And
all the work I'm doing. And it really comes down to valuing businesses at the end of the day, and you know, where can you buy? That is still the big picture. But all I'm doing is trying to put the odds in my favor and just bet with the people who are being paid like I am.
Absolutely, and thank you for that. Well, listen, I think we've got a few more, but are there any stocks? I know you mentioned GE. Is there anything else interesting, maybe a bit smaller, maybe a bit off the beaten track that you're looking at the moment that, you know, you just want to highlight, or anything you've traded recently, really, that you want to disclose?
You know, I did special situation investing, and I still do some on the side. And you know, if I were teaching anyone to invest right now, and got 5 kids and 2 of them actually do special situation investing as part of what they do. So I taught them this, and I would do it all over again. But I'm doing much more quantity stuff now because that's a full-time job. I got a big team of analysts and tech guys, and it's not better or worse than special situation investing. It's just different and kind of interesting. And I did special situation for, you know, over 30 years, and I still have my hand in it, but I'm not actively involved right now. But if I were starting again, that's the only area I'd be in.
Wow. Okay, that's a good endorsement of the space.
Yeah, and it's really, you know, if you stay in smaller cap names, if you stay in harder to analyze things, you're going to end up, if you're good at this, get rich. And when I taught at Columbia for 23 years, and I told my students, I say, you know, what happens to people who are really good at this? And I say they get rich and they grow out of some of these smaller cap names and options and things of that nature, and it leaves a whole new generation available to compete in that area. So it always regenerates for young people who are trying to make their fortune. It's a great way to make their fortune. And if you're really good at it, you can grow out a part of the space and leave it for the next generation to do it. So I don't think it'll ever go away, really.
Let me ask you one more question before you go, because I know you're pressed for time and I appreciate it. Why do you think there's so many spin-offs right now?
I'm sorry?
Why do you think there's so many spin-offs coming through the market right now?
The real answer is I don't know, but I think that there's a lot of active money in the market. I think that the market's not cheap. There's limited ways to create value. I think people are searching very hard to push valuation. You know, management is looking to push the valuation of their business to create value, and this is one of the levers they can pull. And there's a lot of pressure to do that because there's not a lot of cheap things out there. And so this is one lever that management can pull. And there's a lot of scrutiny, and there's a lot of ability from when I started 40 years ago, a lot more information out there, a lot more accessible, big, small, everyone is sort of in a glass bowl, all public companies. And so they all probably feel the pressure to perform and do well and not just sit there and have their stocks stay where they are. So I think everyone's under more pressure to perform, and this is one way to do it.
Okay, fantastic. Well, listen, thank you, Joe. You spoiled us today. You promised us a little less time than that, and you've gone over. So we do appreciate that. Appreciate your insights. Thank you very much. And yeah, that's great today.
Good luck to everyone. And it's a very nice cause that you're working for. So thank you for including me.
Absolutely. Thank you, Joel. Take it easy.
Okay, bye-bye.
All right, guys. Well, I think we're going to go on with Jonathan in a moment. I mean, if the other panelists want to stay, I don't want to keep anyone too long, but they want to stay, then I'm going to bring Jonathan in because he's, I'm conscious of what's going on at the moment. I don't know if we've got many questions coming for the guys here, though. That's all. I don't want to stay too much. Did you have any questions you want to answer, Paul? Or? I don't think there's many, but I just want to. I'm conscious of the time as well, but I want to bring John in. If the other guys want to leave, that's fine. But I want to bring John in because what we're going to do is we're going to talk about the up and coming calendar of spins and what we like. And what we look for. And like you say, you've seen today, very much what we analyze in a nutshell. We've got the fundamentals. Paul brings in the fundamentals. We've got David's view on management and conglomerates. We had George's ideas on the insiders, Jim's on the activists. That's what we do as a firm. We look at all these sort of situations, we analyze them, we play them up for you, and we pick the best ones. And as Joel said, they don't all make money. Don't expect some pot of gold you can call up and trade them all and win, because you won't. What it counts is expertise and picking out the good ones. But as he says, it's a great place to hunt. And certainly my view, and I told Barron's the other day this, that there's a lot of spin-offs purely because, and Joel would adhere to it as well, that there's a lot of money in the market and companies are searching for value. And with valuations as they are on companies at the moment, they've got to look for more value. So they look inside themselves to create that value via spin-offs or other corporate activities. So that's what we got at the moment. And they could be good names, or they could be names for shorting as well. Someone asked the question, what do you look at for shorts? Well, we look at shorts as we analyze everything, fundamentals, technicals, and insiders. And we go down that sort of list and we look at the management, we look at, whether it's going to be ejected out of an index, and we look at whether fundamentals is a good business, and we do all that stuff. So that's what we do for a living. So if you want any of that, do check in with us via the website, and we can discuss a little bit more here. We have a nimble service, and we have an institutional service. So I'm going to hand over to John. Excuse me. But it's been a real pleasure today for me. I've learned a lot. I hope you have too. And so John's our residence deals analyst, and he's going to give you an overview, a few slides on that. And like I say, we're going to do a raffle after that. So sit tight for another 15 minutes if you can. And we'll give away some prizes as well. If you want to donate anything, then go on to those links that Paul sent in the chat. And yeah, it's been a fantastic day today. I'm really excited, really great that we're able to reach our targets for the charity of and everyone helping us. But let me hand you on to John. If you need to contact me or anyone else, then do reach out. We're a pleasure today at the Pen Club. What a fantastic place. If you're in town, drop by, talk about their membership. It's a great place to be in the city. And really thanks to the other donators as well. Lamani around the corner, great restaurant if you're in town. We're going to give away a dinner for two there. Fantastic place. I'm always there. And also the Yankees will give away some memorabilia. So really appreciate everyone, really, because it wouldn't be possible otherwise. So I'm going to hand on to John. He's going to take you through the calendar. Do stay for that, and do stay for the raffle. And then I promise you I'll let you go, and your bum's going to be a little less sore. So let's hand over to John for a second. But thank you for everyone today for your contribution.
All right. Hey, good afternoon, everyone. Wow, what a presentation, what a treat. I feel like I'm going after Dave Chappelle. How do you follow that up? but no, first things first. Again, I'm Jonathan P. Morgan, and I do want to echo the same thing that Jim and the team has said. Appreciate everyone who signed up for our 5th conference. And this is our 2nd webinar, helping such a worthy cause, and to gain access to some very unique ideas and insight into the space. So I've been with the team for the last 11 or so years. I work with Jim and the team of analysts. My role is speaking with our clients on the latest ideas themselves, looking for that data around spinoffs as well. And also, as I'm part of the team on the activist research. So we look for activist ideas, companies that we do believe could do a breakup. And of course, trying to fit that into the criteria of our current activist clients that we have on board. So yeah, this is now my 5th time presenting at our annual fundraising conference. And it's always a pleasure to be speaking alongside such distinguished guests and experts on the panel. So I will be sharing my screen now, just with regards to our latest conference. So just give me 1 second. All righty, let's share that. All right, are you seeing my screen, guys? Yep, all good. Perfect. All right, great. So, I mean, taking back to the previous conferences, just kind of doing a quick overview. We did look at investment opportunities in the spinoff timeline. So our first one, we did use our proprietary data at the time to look at 4 different buckets. So announced spinoffs, the performance of those, going through how they've done. Looking into companies trading post-spin, so within that 2-year period. Also looking at the companies post that 2-year tax-free rule, usually the next takeover play. And interestingly enough, as you can see there, we highlighted one name at that very first conference, Varian Medical Systems, VAR was the ticker, $10 billion company at the time, bought out by Siemens Healthineers Q3 of last year. So that was really interesting to see. So that was our first conference, and ideally the road changed with regards to that. Second conference, we looked at where to find value in spinoffs. So looking at companies, so trying to break it up into how have they performed in the first year? Is it the question that came to Joel was, do large caps perform better, mid caps, small caps? Our study said that 4 out of 10 spinoffs are flat or negative in the first year. So you don't want to be buying everything right out the gate. And that's what we do to highlight to our clients, to explore where is the best place to look for these names and sectors. The third conference, we also looked at misconceptions of spinoffs in the market itself. So, do they make money? What are the recent data telling us? What should you be doing now? And we updated our analysis for that particular conference. And then our fourth one, we encompass all 3 of those conferences to look for some of the best special situations to watch out there. At the time, we also looked at that mega conglomerate pharma player, Pfizer. They were leading up towards a spinoff at the time, which they had an upcoming catalyst. They spun up with Viatris. There was some smart insider buying that was taking place. And this one in particular was a particularly rare breakup dynamic in the S&P 500 listed spins that looked to be a great opportunity. And when it listed on the first day almost a year ago from now, in November 17, 2020, it's slightly outperforming the market, but it's nice to see that has given a decent return. And also we also looked into Harley Davidson. So again, looking at where the smart insiders are, the CEO was buying shares at the time. That's the legacy motorcycle maker, Harley Davidson, and just looking for CEOs with a proven track record. So game-changing CEOs, as we like to call them here at the Edge. And again, at that presentation, the stock has appreciated since then. So with today's presentation, I'm going to try and wrap this up in the next 10 minutes, so stay put. But what we're going to be looking for is what's happened in the spin-off space recently. So as mentioned previously, the space is starting to grow and evolve, and also using a lot of the same things that have been highlighted in today's conference. So looking at David Marcus's presentation with regards to conglomerates, looking at George's presentation with insider buying, and even looking into the value creation as well. We're going to be seeing elements of this in this particular situation that we're going to be highlighting later. So just a quick one, what's happened in the spin-off space recently? So we've been seeing in 2000 and this year, what have they done? So there were 17 global breakups, so about 35 new companies in total coming onto the market. So when we look at spin-offs, we're looking at $1 billion plus. We're global in nature. Interesting, that was the lowest since we've seen in the lowest time we've seen this amount of spins was in 2010. We also saw that the performance actually was quite remarkable at the time, up 65%. So if you just bought a basket of all these spins, you're doing quite well on the back of that. The breakup in terms of 2020 was more heavily weighted here in the US versus the rest of the world. So that was interesting take to see as of last year. And of course, during the pandemic, it put a lot of spins and companies on hold. There were some companies that were looking to do 2020 breakups. They opted not to do that. Maybe we saw some of the better spins go through in 2020. Maybe it was a timing factor. But then this led into a rush of situations going through in 2021. So as it stands today, again, kind of over that 1 billion market cap level, I mean, we're already at 25 breakups. So 50 new companies in total as of last week. And potentially looking at the calendar, it could be north of 30 plus names. So the last time we saw this amount of spins, 2017 and 2018, where you saw over 30 situations going through at that point in time. So that's almost a 70% increase, almost doubling what happened from 2020. And the breakup, the makeup, if you will, I've been getting questions from clients is what's been the makeup of these situations? It's actually, we're seeing more and more global situations going through. So David Marcus mentioned Vivendi spun off Universal Music Group this year. That was one we covered as well. European situation. You can go to Australia with Woolworths Group, ticker WOW, going through their breakup, Travis Perkins in the UK. So we're seeing a lot more coming through from outside of the US as well, which is quite interesting. So with regards to what we're thinking 2022 and beyond looks like for the spin-off calendar, I'm going to save that for the very end of the presentation. It'll be a few slides after, but we believe it is going to start to keep going up from here. And again, encompassing everything that's been highlighted previously, this one company currently is on the spin-off calendar, and we believe has a number of ingredients that could make for a very strong spin-off. And that company is Colfax Corp. CFX is the ticker. It's a $8 billion market cap company. They're in the fabrication technologies business. They are guiding for a Q1 spin. So January, February, might even spill into March, but Q1 is their guidance for that situation. And this is actually a co-founded by the billionaire brothers, Stephen and Mitchell Rills. So they are the co-founders of Danaher Corp. Of course, Danaher global conglomerate, again, doing breakups in the past, based here in the US. I think Danaher is about 200 plus billion as it stands today, but they have done spin-offs in the past. And that's why we looked at this to see what could these billionaire brothers be doing now with Colfax, hence they've announced the spin-off. So executed another spinoff. And if you look at their track record, so going back to seeing how they performed in the past, they did a spinoff Fortive back in 2016. And you can see the returns. I mean, outperforming Danaher, the RemainCo, doubling what the S&P 500 did since that previous spin. Fortive didn't quite outperform the market, but it still made a return. And they also did a spinoff as well. Fortive did their own spinoff with Vontier almost a couple of years ago, or last year in October. Now, if you look at that one, the market itself has outperformed Fortive and the spinoff. So why am I highlighting this? So there's a couple of reasons here, but they have done other transactions by the brothers. They did a Danaher split, so it wasn't quite a spinoff getting shares by holding the parent company. They did an IPO spin of their dental business. That again, and also Fortive, they did also exchange offer as well, kind of a merger / exchange offer of Ultra Motion Control Corp. Now, the reason why I'm highlighting this, again, if you look at Danaher, the RemainCo, that again has outperformed the market. So 97% versus the S&P only 47%, again, doubling over that IPO exchange offer. Even the NewCo was up a little bit as well post that. If you look at Fortive, the RemainCo, 11% versus the S&P 60%. So the reason why I'm highlighting this is that the brothers there's more interest, they have a greater interest in Danaher than Fortive. In fact, and since 2019, the brothers have been cutting their shares quite significantly. They've been decreasing it by 60–70% in Fortive during that same time. And none of the brothers have a position or a title in Fortive, previously stepping down from the board, but both are present in Danaher. And that leads us to our next point, which is follow the money. Where is the money? So if you look at the share price, the stakes, Danaher is Stevens and Mitchell's overall holdings are found in Danaher. So over 90% of their holdings are there. Close to 13 billion for Steven. Mitch has about just close to 9 billion market cap. What's the next biggest holding in their portfolio? It's Colfax, CFX. So while not as billions of dollars in Danaher, they do have about over 400 million each as a position in CFX, and also as mentioned with Fortive, both brothers do hold a position here, but they have been reducing that recently. And Mitch is a non-exec chairman of CFX as of today. And as mentioned in the previous slide, none of the brothers have a position in FTV at the moment. So therefore, based on expectations that Mitch is going to be on board remain the chairman of both the parent and the SpinCo, and seeing that there have been strong returns in Danaher, it leads us to believe, similar to what Joel was mentioning, they're not going to ignore this company. They're going to spend some time and really create a value creation situation here. So with that being said, another thing jumped out to us. We found out that there was an insider buying from Mitch himself this year. So if we go to the next slide, you can see a 10-year chart of CFX where, again, insider buying from Mitch Rales, the co-founder, the chairman of Colfax. He bought shares at about just a few months ago in August. He spent about $11 million of his own. So going into his pocket and spending shares, he bought around the $46 level. And again, this was after the announcement of the breakup, which is quite interesting. But more so, if you look at that purchase, this is his first buy in over 6 years. And what makes this purchase particularly interesting out of all the other 7 spins purchases he's done in the past, as you can see, that's come through on the left-hand side, this is the second largest buy that he's done ever with Colfax. So the biggest one being there, that 23.1 million back in 2015, August 2015. He also made a $10 million purchase there. But the other previous buys don't go above $1 million, as you can see, more 600,000, 200,000, 700,000, etc. So he definitely has a good track record when it comes to these buys. You know, we're looking for track record. So his track record is right now 7 out of 8 buys in Colfax have made money. And you can see the next chart showing the greens, 100% return, 74%, 77, 14. The one loss coming at 16%, where he actually spent one of the least amounts during that time. So him having a track record and the average buy return close to 40%, you know, that's definitely an insider to follow. And you know, we like to see that in a particular spin-off or a situation. And it's also worth noting, from a side note, that Mitch is also 8 for 8 buying shares in Danaher. So again, a very good, strong track record when it comes to insider buying. And but one thing to highlight again with Fortive, he's not bought any shares there. In fact, he's sold shares at Fortive, as mentioned, cutting their shares by 60-70% and going through from 2019. So kind of wrapping up other points to this situation as well. I mean, we do see some room for upside since the announcement that they announced that they're going to do the spin-off of their fabrication technology business. So FabTech, and the RemainCo is going to be, the retained business is going to be their medical technology business, so MedTech. The stock hasn't really run up as we've seen sometimes with other spins where it's up 40%. There's not a lot of upside going into the spin-off itself, and it's slightly underperforming the S&P. So, and from that standpoint, the stock hasn't run away from us. So there's still an opportunity to take a look at this ahead of its Q1 spin. And we had an activist in Jim at Barrington on board with the presentation. There's an activist in Colfax, and funny enough, it's Starboard Value. They took a position in this stock Q3 of this year. So after the announcement of the spin, but they looked at it from at the point of view that the stock is undervalued, and there's still multiples, there's a multiple expansion opportunity post-spin for these situations. So speaking of, just on a side note, everyone listening, speaking about activists, we are going to be following up from we did a King of the Activist study earlier in the year, and we released that in January. We're going to be refreshing that study for an upcoming release, hopefully by early next year. But that is going to be examining preferred strategies and of the top US activists out there. So which campaigns have worked? So we can go into the Starboard value position and see, is this going to be a really great situation for this industrial company? What are they looking for going forward? So kind of using the data that we have to dig deeper into a situation like Colfax, get a better understanding of what this could mean for the spinoff going forward. There isn't going to be, for us on the technicals, so Jim mentioned fundamentals, technicals, insiders. We haven't even touched the technicals, more the insiders. There's an index play. It doesn't look like there's going to be any selling pressure initially, which is a good sign. We like to see those type of spinoffs. It's not highly levered, so there's not going to be that huge transfer of debt onto the SpinCo or left on the RemainCo. So with all of that being said, I mean, it's starting to, add up to be a really interesting situation, with regards to value creating spins by the Rails brothers. There's been some recent insider purchases. There's an activist involved, and looking at our proprietary spinoff data, industrial spins in that first year of trading here in the US have given a 15% return. But we at the Edge, our job is to look and find the best opportunity to give you an even greater upside from that 15%. So that's just taking the highs, the lows of the situations, and using our expertise and the data. And we believe that CFX is definitely has a number of ingredients for a strong spinoff. So therefore, we recommend adding CFX to your watch list and ahead of the spinoff early Q1 of next year. So other quick stocks in focus to highlight. We're also looking at Daimler. They're coming up with their breakup in a few weeks' time. We have our analysis ready for that. But it's spinning off their truck and bus business into Daimler Truck Holdings, renaming the parent company to Mercedes-Benz Group. That's unlocking brand value there. We've seen this type of spinoff come through with Ferrari. David mentioned with regards to the Exor, you're pushing with the Ferrari spinoff with Fiat. I mean, that was a fantastic situation, up, 400% since the spinoff back in January. That was a great situation that we covered. And another one, kind of a little bit of a off the cuff situation that we like, and I'll tell you the reasons why we like this one. Swedish Match, a $12 billion market cap company spinning off their US cigar business here in the US. Now, why this is unique and interesting is because we haven't seen too many EU or a European companies spinning off a US company and mainly doing a spinoff. We saw that with Altice USA, and we also saw that with a recent spin, and this is actually one of our high conviction calls, Jackson Financial, JXN, where essentially the Prudential spun off Jackson Financial here in the US. There was no listing in the UK, and a lot of the UK funds, UK only funds, just sold their shares in Jackson. So it sold off all the way down to the bottom. We push clients to get involved. And, as of today, Jackson's up close to 50% since its spinoff back in September of this year. And if you look at the other peers, like Bright House and Equitable, they're up 25, 17%. So far, this has been a real outperformer. So this one in particular, coming up second half of next year, staying true to form. Maybe it's not worth buying right away, but there could be a sell-off that could create a really interesting opportunity for this one. With the calendar coming up, we still have a 5 or more spins or so coming up before the end of the year. So we're quite busy. And here in the US, looking at the last closing slides for the calendar, there's about 16 US names looking to break up. If you put overlay that with what's coming up in the global side, there's about 27 so names looking to break up going forward. So that's really what I wanted to highlight. What's coming up on the calendar. And in closing, we look forward to make this presentation available afterwards. So if you do have any questions, we won't be doing a Q&A right now, but if you have any questions, do contact research@edcgroup.com. If you have any interest to speak some more, as mentioned, I'm Jonathan P. Morgan, and look forward to speaking to anyone with the upcoming situations. But I'll now turn it over to Paul. He's going to do the final remarks, and we'll wrap this up in the next 10 minutes, but appreciate the time.
Thank you. Thank you, Jonathan. You guys have to mute. I think that will work. All right. Fantastic day. Well, certainly the Edge, once again, I think this is your 5th conference. I've been to all 5 of them. I always walk away with like 10 pages of notes, so I always find them fantastic. As Jim said a moment ago, we got a little bit of everything. We've got some technical stuff with George and his 40 years of experience, and David Marcus, one of the great investors out there. I just love listening to just his passion, his insight, and his advice, but fantastic. We had the role of activists. To hear Joel speak, I haven't heard Joel speak in a number of years, so have him come and talk about this area is great. Really was the founder, I think, of institutional spinoff research. So it's really fantastic. So a great day all around. I loved it. And we're going to end with this raffle. How much money in the end did you guys raise?
Just over 15,000.
Just over $15,000, which is absolutely fantastic. The last record was around 6,000. And to be able to contribute to the Alzheimer research is really pretty terrific. All right, so we have 3 prizes. Limani, which is a restaurant here in Manhattan, fantastic food. It'll be a fun night for 2, dinner for 2. And then the Penn Club, one night stay and dinner for 2. I always like hanging out at the Penn Club. It's where Jim and I have lunch. They have some surprisingly terrific food for a university club. I always enjoy the lunch. And then the final gift, final raffle will be the New York Yankees memorabilia. We have a 2018 signed baseball. That was the closest the Yankees have been to the World Series in the past 10, as well as the yearbook, signed yearbook. All right, so I have all the raffle tickets in front of me in a Penn Club laundry bag.
You got mine in there, Paul.
Yeah, I've got yours in here, and Jim paid me a little extra. All right, so Limani, dinner for 2 goes to Michael McDyer from, hold on, Atlas Capital Management, Flemington, New Jersey. So congratulations, Michael. Dinner for 2. Don't tell your wife who you're taking, but dinner for 2. All right, congratulations, and thank you very much for supporting the cause. All right, we're gonna go to gift number 2, the Penn Club. Yeah, this is a great gift, particularly now with the holidays here, coming to New York. I live in New York. It is absolutely unbelievably high energy in New York. You wouldn't think there was ever a pandemic. Restaurants are full, streets are full. The energy is unbelievable. So the opportunity to come and spend a night in New York, have dinner here and see the sights or see the tree or something like that. Absolutely terrific gift. All right, I'm digging through. I'm definitely going to try to find Jim's ticket. I got it. All right. For the Penn Club Award, Arthur Ainsberg, who is Ainsberg Associates in New York. All right, so you can get away from home. Again, don't tell your wife about this gift. All right, congratulations. And also thank you very much for supporting this fabulous cause. We're going to the final gift. You got to bring it up so people can see. Bring the slide up. The other Paul. We're dueling Pauls. All right, New York Yankees memorabilia. I was talking to a good friend of mine who is a diehard Yankees fan. And I said, what do you think of these? He said, these, I would like to have these too. This would be nice part of my collection. So I thought that was pretty cool that Jim got it. All right, got the ticket. Oh, wait, 2, putting 1 back. I didn't look. And the final winner is Mark Fleischhauer of Owl Creek Asset Management, also here in New York. And I'm sure you are a Yankees fan. And those are our final raffle. I think that's basically the end of it. I want to thank everybody for participating. Thank you, the panelists, the presentations. It's really world-class people. And I think a lot of really goes to the edge. They've collected a fantastic network, an ecosystem, clients and resources. And the work they do, I think, is the best in the area. They really bring both a balance between money making and the patience that's required. So thank everybody for their support today. And with that, we're done.